And boom. So, yo, what's up for everyone watching this on the YouTube replay? I hope you're having a phenomenal Sunday. So, I like to start these streams off by doing a quick portfolio update. I'll share with you how all my stocks are doing, and then we'll look into some stocks that I think are going to be good companies to buy this week because the market opens tomorrow. So, let's start with my Robinhood portfolio here. In the top left, I call it my dividend only portfolio because every stock in here pays a dividend. Year to date, we are up 3%. And over the past year, we are up 18%, which does underperform the market. So if we click on just the S&P 500, the S&P 500 is up 30% the past year, and we're only up 18. I'm still not complaining, though. I'm still really happy with my 18% year. And here are all the stocks that we own in here. I got some really popular S&P 500 names like Google, Meta, McDonald's, Constellation Energy. And here's my total percent change at every stock. So we are green on every holding except for McDonald's. We're slightly down on them, but I'm not too worried about that. We also have the Roth IRA. On Friday, our Roth IRA was up 6.78%. And mainly that was from just Innodata right here. This company was up 85% just in one day. Literally just in one day, they were up 85%. I couldn't believe it. So yeah, that's our Robinhood portfolio. And then we also have a Moomoo portfolio. And yo, what's up, big mans and Louise? Shout out to member Louise and Aaron, Monkey D, Luffy. Good to see you all. I hope everyone's having a great Sunday. I have some great stocks I think are going to be good buying opportunities this week. And then here's my Moomoo portfolio. This is called my buy and never sell account because once we buy a stock in here, we just diamond hand it. We don't trim it. And we are up. Oh, yeah. Also, happy Mother's Day. Happy Mother's Day. We are up year to date 73%. I literally can't believe it on a return money weighted, and that's mainly from Comfort Systems and Powell Industries. Comfort Systems is now up 100% year to date. Our second largest holding is up 200% year to date. Amazon, I think, is up like 15% year to date now. They're very close to an all-time high. Amazon is just one of the best stocks out there that exist. I got Coca-Cola Consolidated. This one had a rough week the past week. That's why our portfolio isn't at an all-time high, but it's still pretty close to it. But yeah, Coca-Cola Consolidated, the bottler fell. Amphenol stock, this one is a great company if you want exposure to AI infrastructure. It's like the nervous system of AI, they call it, because they supply the interconnects and copper cables for Google's TPUs and Nvidia's NVLink spine. And they're not even expensive. They trade on a forward multiple only at 24 times next year's net income. So I want to dig into that one a little later. And then we finally, I know last portfolio here, we finally have our Weeble account. This is just our risk on portfolio. And here's our open profit and loss. If y'all want to hit the follow button, I appreciate that. I'd be fully transparent. I go to a bunch of other streams. No one shares their lifetime return on their stocks that they're talking about and analyzing. They don't show their lifetime performance and all this, and I try and show everything. If you got any questions for me, let me know. So yeah, here's our total percent change on every stock. Here's our big losers like UiPath, Sprouts Farmers Market, Zoom, Progressive, but we do have some big winners to offset that. Like AMD surprisingly hit a crazy all-time high on Friday. You know, back here they were calling this one Advanced Money Destroyer. Now this is like Advanced Money Duplicator because AMD with Intel's earnings and moving manufacturing back to America, AMD has just been to the moon. And there's a new like chip shortage, like CPU shortage. So they're able to raise prices by a bunch. So, hey, what's up? Someone said Meta is so bins. Yo, actually, I want to go over Meta because that's one of my favorite companies. And hey, Lori Sell, or I'm probably saying your name wrong. Lori, thanks for the rose there. I greatly appreciate that. Hope everyone's having a great Sunday. Happy Mother's Day. You think Micron is going to go green or red tomorrow? That's a good question. So speaking of this memory shortage or this chip shortage, one huge shortage in the market right now is memory. If you go on Amazon, try and buy an external hard drive or memory like RAM, it costs like 5 times more than it did 2 years ago. How do I know? Because I was just on Amazon buying a SanDisk external hard drive and the sucker was so expensive. But yeah, anyway, here's why I low-key think that they might short-term go down, but I think they're probably going to continue to climb higher. Here's my crazy thesis why. It's just that a pure valuation point of view. So this is a growth company, so you really want to value them off next year's net income. And check this out. Micron on the right, the forward PE is an 8.1. which means in English, they only traded 8.1 times next year's net income. Here's the actual analyst projections. That's the orange line here, or here, that's revenue. Here's net income. Next quarter, analysts are projecting 22 billion net income. and then 25 billion in net income the quarter after. It's never even been close to that before. Like already this was a blowout quarter, 13 billion, but the growth is not done here. It's still going to have more than a double. It's going to 21 bill, then 25 bill. So I think this 8 forward PE can still stretch up. It has room to stretch to like a 12 or something before it maxes out. So point being, if I was a shareholder in Micron and I was up a bunch, I wouldn't fully sell out of my position. I would trim, trim very slightly, but definitely don't fully sell out. I don't know if I'd buy any shares here though. How do you keep watching all these individual stocks and not just do index? Hey, that's a good question. You know, I just enjoy this. I always love deep diving into stocks. Yeah, hey, appreciate that. Yeah, I'm on a brokerage right here. It's on my description. All right. Hey, yeah, thanks for that. Sorry, I'm a little behind on the chat here. Armithal, how's it going, man? And Tomboy, hard to buy stocks when most of them are at all-time highs. That's a great point. So if we just look at the S&P 500, boring index, S&P 500, if you have ever bought the S&P 500, you are up on your money because it just hit an all-time high on Friday. And most retail investors and hedge funds can't outperform the just boring S&P 500. So that's why I always recommend having the S&P 500 or the NASDAQ 100 as the backbone of your portfolio. And then play around with some individual stocks that you know, love, and use. Like if you use Amazon and Google and Meta, buy their stocks. So I actually want to go over as one of the first companies, Meta. I saw someone talking about that one. And yeah, they have kind of not done too good over the 1 year chart on Meta. Meta is only up 0.99% from 1 year ago. And let me share with you why I think this one is a steal of a deal. They're just being hurt right now because analysts aren't happy with how much they're spending on AI, but that won't scare me out of Meta. I love what they're doing with the Meta Ray-Ban glasses. They're doing some robotic acquisitions. Actually, let me see if I can find that news. Yeah, the second line here, Meta acquires humanoid robotics startup, Assured Robotic Intelligence. Pretty cool. So let's go look at their actual fundamentals because Meta is a money printer and look at the valuation. This is what I'm most bullish on. Meta, the Mag 7 behemoth that owns Facebook, Instagram, Messenger, WhatsApp, Threads, all that. They only trade at 19 times net income, which is an earnings yield of like 4%. You could buy a 4% money market fund or you can buy, Meta. And check this out. Meta has 3.54 billion daily active users. So pretty much half the world is on a Meta app once a day. They just disclosed the average Facebook user in the US makes them $50 a year. The revenue grew 33% year over year. That's why I'm so bullish. The revenue, the organic revenue, the lifeblood of the company grew 33. I think the multiple should be able to stretch up higher. But here's the profits they're making. They're making 20 to 22 billion. Oops. Meta makes 22 billion a quarter of net income. So remember that they make 22 billion, but look at how much they're spending in the two most recent quarters. 34 billion. So they're actually spending more than they're making. And with their new Prometheus bond issuance that they did last quarter, they now actually have a net debt position for the first time. But that's not scaring me out of Meta. It's actually, this AI is helping out the revenue. This is the highest growth rate on the whole screen they've had in years, 33% to revenue. Super impressive. I love the Meta Ray-Ban glasses. So a 19 forward PE can easily stretch up higher to like a 24, 25, and it would. Anyway, hey, Junior, dude, thanks for those 3 gifts there. I greatly appreciate that. I hope you're having a great day. Please do SoFi. Ooh, yeah, SoFi. This is a cool fintech stock. If you're looking for like a financial tech industry company, I do own SoFi, full disclosure. What happens is, hey, I'm on a brokerage right here. This is where you buy stocks. It's on my profile link if you would like to get it. But SoFi, this is a really cool fintech company, and it's a pure growth stock. The metric you want to look at and really judge this company off of is their financial services, and this is the real growthiest metric that no analyst expected it to be this growthy. Look at these year-over-year growth rates in the middle. This is what justifies the high multiple for the long run. Revenue's growing 42%. After grew 101, after grew 86, after grew 244, after grew 264, they are on a streak of growth. And check out the analyst projections to the net income. It's supposed to hit 240 million of after-tax net income in 2 quarters. So there is real future growth to the after-tax net income. And look at the revenue. Organic revenue's up 42%. They didn't do an acquisition to get that. That's just real growth, 42%. That's what you want to see for a growth stock. You're just going to diamond hand when the revenue hits a record every quarter. And check this out. Another thing that, makes sense to me is the fact that SoFi, again, growth company, you judge them off next year's net income. This is stupid cheap. SoFi trades at a 22 forward PE, only 22 times next year's net income. That's why I think SoFi is a great time to buy into it, but not crazy. Like if you wanted this as 5% of your portfolio, don't make it 5% today, but you go ahead and make it like that 1%. You start that nibble. You know what I'm talking about? And full disclosure, I do actually own some SoFi shares. 24 shares left, but I regret every share I've ever sold of SoFi. But I might actually get the opportunity to buy some more shares in them because they are pretty cheap now. I can't believe it. 22. It is a good time to buy them. Not financial advice. None of this is. Yeah, watch out for people impersonating me. I saw someone in chat I had to ban. I'll never follow you, DM you. I literally sell absolutely nothing. Just want to give my opinion. None of it's financial advice. I might piece out my PC and sell the parts. Hey, maybe you could buy stocks with it. Okay. What's next here? There's so many stocks. I apologize. Yeah, Hermie, I agree. SoFi is at a good place right now. Eaton stock. This is a cool electrical infrastructure dividend growth stock. So Eaton, they've done phenomenal, pretty close to an all-time high, a little off their all-time high. But if you buy them right now, if you buy the stock right now, you still get over a 1% dividend. So you buy it now, you get 1% of your money back just in a qualified dividend every year, not including the stock price appreciation that you get every year. And historically, they give you like 8% stock price appreciation on top of the 1% dividend. And I'm just a big fan of the electrical infrastructure super cycle that's happening right now. They're also in aerospace. How's that business growing? Wow, look at that. It's growing. It's the highest growth rate on the screen. It's actually their aerospace business is growing very nicely, but they print net income. Check this out, easily like close to $1 billion of after-tax net income every quarter. So cool. I like Eaton. They're a little expensive though. I mean, the forward PE is a 31, but look at how that changes. Like, look, the current valuation. So they get much cheaper. They're currently traded a 39 PE, but only a 31 forward PE, which is significantly cheaper, which means there's a lot of EPS growth happening through this next year. Joseph said, what platform is this? Yeah, hey, this is a brokerage where you buy and analyze stocks on. So, they ask for a bunch of information. If you'd like to get it with my affiliate link, it's actually on my profile link there, like the description. It's called Moomoo. You can just type it into Google, though, broker called Moomoo. All right, so what's next? Sorry. Who asked about Meta from the chat? Yeah, hey, but I'm reading both the YouTube and the TikTok chats. So hope everyone, I'm reading both chats here, so don't worry. Robinhood stock. I do own Robinhood. I'm a huge fan of brokerages. So Robinhood's a little expensive. And full disclosure, I do own Robinhood. I regret every share I sold to them. I only have 5 shares of Robinhood left. Look at this. I used to own 55 more shares, but I sold it at $36 a share in the middle there. And now Robinhood today is at 77. So one of my biggest regrets in the market has actually been selling out of Robinhood. But let's actually analyze them because I love what they're doing with the prediction markets. That's making them a lot of money because whenever you go buy and sell crypto, buy and sell a stock, do an option, do a prediction market, they keep a high margin fee every time you do that. And specifically, these prediction markets are their highest margin product ever. Every time you do a prediction market contract, they keep a 2% fee on it. Every time you buy and sell a stock, they keep a 0.1% fee. So these prediction market contracts are 20x more valuable for their bottom line. Here, actually, I use Robinhood. I have a Robinhood brokerage, and I never recommend doing these because it's pure speculation. But I think you know what I'm talking about when I say prediction markets. It's like this kind of stuff. They have a 2% fee they keep on that high margin for them. So 20x more valuable for their bottom line. That's why they're pushing it, and they have really good net margins here. Net margin right here. Notice every quarter, this is like collecting royalties, 30 to 40% net margins. So for every $100 that come in, they keep $40 after tax. Kind of cool. But the only unfortunate part is they have had a little slowdown to their crypto revenues, and the forward PE is expensive. They traded a 37 forward PE, which is really too expensive to buy anything meaningfully. Could be decent to slightly nibble, but not anything meaningfully yet, as much as I do like Robinhood. And I am a shareholder of them. I want to see them do good. I do have a nice alternative for you, though. FUTU stock. Actually, so there's Robinhood, and then actually FUTU stock is this app right here. So this app I'm using to analyze stocks is just like Robinhood. They're also publicly traded. So this brokerage I'm currently using is ticker symbol FUTU. It's called Moomoo in the top left. And look at their valuation. A 14 PE, and check out the net income on this. That's why I love the whole brokerage industry. It's not just Robinhood. I love all brokerage stocks. I own SoFi, I own Moomoo, I own Weeble, I own Robinhood. I love the whole fintech industry. They made, after paying over 100 mil of taxes, they kept 433 million, and their net margin was a 52%. which is pretty crazy. So yeah, this app I'm on has 29 million users. Pretty cool. So they actually collect a lot of interest income money. So check out how that's grown. In 2019, it was 59 mil. Now it's 1.3 billion. This app I'm using right now, look in the middle of my screen. They give you for free a 3.35% APY. And that's what you get on your idle cash. They earn like a 4% APY on it, and they just pocket the difference. It's all high margin. It's genius for them. Anyway, if you'd like to get this app I'm on with my affiliate link, I actually have it on my profile link. So yeah, it's a broker called Moomoo. If you deposit $100, we'll both get like a free stock too. It's in my profile like description. Hey, what's up, Matt? Good to see you all. But you don't have to use my affiliate link. I'm not trying to push that. You can just type it into the App Store or Google. It's called Moomoo. But yeah, it's my favorite app to analyze stocks on. All right, so let's keep going next year. How do you think Micron will go? I don't know. Literally 30 to 40% higher. And that sounds crazy. So Mass, how's it going? Said, is CoreWeave good? That's a big Nvidia holding. Oh yeah, that's another cool thing about this app. You can like see what the super investors own. So check this out. Here's the Nvidia portfolio right here. Nvidia owns a bunch of Intel, CoreWeave, Nokia, Nebius. They actually just bought like Iris Energy, but CoreWeave, Nebius, Iris Energy, they all do the same thing. These are data center stocks. So basically all this company does is own a bunch of graphics cards in data centers. Nothing too proprietary, but basically these graphics cards are in such demand from cloud computing companies like the Azure Cloud, the Google Clouds. They're actually renting out the capacity of the graphics cards because they're too expensive right now. The only thing that scares me is, if you know what a moat is, like a barrier to market entry, there's no real moat here because all they do is just own a bunch of graphics cards. There's this depreciation thesis, and it's not a profitable endeavor. So the bull case is, look at the revenue expectations from the analysts. Revenue's going to hit in 2 quarters, $3.4 billion. Isn't that insane? It's never even been close to that. Look at the current revenue, $2 billion this quarter, up triple-digit growth rates for the past 6 quarters in a row. And it's at $2 billion, and it's going to 3.4. But the bad news is they're going to triple their losses. Look at this. They're going to lose $685 million in net income next quarter, $600 million the quarter after. So that's the only thing that scares me is, like, they have revenue growth, but it's not a profitable business. The more revenue they get, the more net income they lose. And what does Morningstar have to say? Okay, actually, Morningstar says they're fairly valued. Robust neocloud demand driven by deep Nvidia integration and a massive take-or-pay contracts will drive long-term growth. Basically, CoreWeave has these deals with Nvidia where they get these Nvidia chips for cheap because Nvidia is buying their stock and stuff because they're one of Nvidia's biggest customers. And then they have the cheapest cloud prices out of all the companies you can rent out GPUs from. CoreWeave has like the cheapest prices. And it's like, anyway, but it's at the sacrifice of their net income. Look at this. So this is the third line. Y'all aren't going to believe this. Here's something that's really cool. The third line here, it says backlog surged nearly 50% to 99 billion. So CoreWeave has a $99 billion backlog. Cool. Net losses increased due to high depreciation, amortization, and interest expenses from capital investments in GPU fleets. Yep. So that's CoreWeave. Kind of cool. I just wouldn't have it as a meaningful size position. Actually, I'd rather own maybe like an Nvidia, a more picks and shovels play. So hopefully that was kind of helpful there. All right, I'm going to sip my water here. How much cash are you using? How much cash are you holding? I only have like $400 of cash. My bank account is drained. I always spend all my money as soon as I get it. So Charlie said, thoughts on AIRO? I think the estimates are wrong. They have a high ceiling contract value. They look very undervalued compared to competitors. So here's Aero Group. Let's figure out why they're at all-time lows, because usually the fundamentals explain it. So yeah, be very careful in the top right. They're only worth $230 million. So the whole entire company is worth $230 million. That's rough. Looks like this company sells drones. It's a drone company. That's 86% of their revenue. And what are the net income losses? So here's the bear case. The whole company's worth $230 million, and it's a company that loses over 10% of that market cap a year. Because next quarter they're projected to lose $13 million, $9.2 million the quarter after. So if that annualized, that's $40 million a year annualized. That's actually 20% of the market cap. So that's rough. So they're losing 15 to 20% of the whole entire company a year. That is, I think, why the stock's at an all-time low. And let's check the short interest. I wonder if that's high. Yeah, so it's definitely rising, a 7% short interest rate. Is there any specific news? Maybe there's some good news. But that's the only thing that would worry me, because these net income projections from the analyst are not great. And it's the revenue growth. Actually, yeah, kind of. I would just be so careful with that one. I just try and keep it real. So Lumentum to join the NASDAQ 100. That's really cool. Yeah, the NASDAQ 100 is just a QQQ. It's a list of 100 basically growthy stocks. I love the NASDAQ 100. Usually it slightly outperforms the S&P 500. Here are all its top holdings. Hey, Dave, man, thanks for that gift there. If you got a stock you want to look at, for sure, let me know. So move to YouTube. Hey, thanks. So yeah, let's do Alibaba. This is a Chinese company, actually. Chinese Amazon almost, but it's not so much like an Amazon. Amazon is more B2C, which is business to customer. Alibaba is more business to business, because it's like e-commerce companies in the US buying stuff in bulk from AliExpress. So yeah, Alibaba owns AliExpress, if you've heard of that before, like an e-commerce shipping company, drop shipping. Yeah, they're not expensive. These Chinese companies usually trade cheap. They're trading at a 23 forward PE, which means only 23 times next year's net income. They got, well, let's go look at their cloud business is growing like crazy. Okay, so they're like the biggest Chinese cloud company. Look at the growth of the Alibaba cloud in the most recent quarter. And this is in US dollars, by the way. We've converted it from Chinese so onto US dollars. And the growth rate of the cloud business grew 42%. I mean, ridiculous. But how about the main Alibaba China e-commerce? That grew 10% year over year, not too shabby. So here's their US dollars after tax net income. They really do make a couple billion in net income a quarter, and that's why the forward PE is a 24. So yeah, you get a dividend of 0.8% yield, 23 forward PE, get exposure to cloud, e-commerce. They own some stakes into like DeepSeek AI, I believe. Pretty cool. Hopefully that was kind of helpful there. Monkey D. Luffy, what's up? Beautiful analysis. Hey, thanks. VITL. What is VITL? What app is this? Yeah, hey, again, this app I'm on, it's a brokerage where you buy stocks on. It's actually in my link in my profile there, for the affiliate link. It's called Moomoo. So Vital Farms, I think this is an egg company. I see BEP. Yeah, hey, sorry, I'll get to all these stocks. Sure, I apologize, I'm behind here. I appreciate everyone that's here, though. If you want to help out the stream, please leave a like. And I stream every Sunday this exact same time. I sell nothing. So here's Vital Farms. Yeah, very small company. In the top right, they're only worth $383 million. So a very small market cap. Let me double check their website, double check that this is that egg company. I'm trying to click on their website here. Yeah, okay. So yeah, they sell a bunch of eggs. So it's kind of a commodity stock. So there is no forward PE. So look at that. The current PE is an 8, but the forward PE is a negative 50. So, okay, look at that. Analysts are projecting them to lose 20 million next quarter and then lose 5 million the quarter after. Someone in chat, Leah, said, Vital is also facing a lawsuit right now. Huh, that's interesting. So I think that might be why the stock is struggling. The future expectations are not good. They're actually negative, They're going, like before today, they were always making, 16 mil a quarter, and now they're going to lose 20 mil next quarter and lose 5 million. So I think that was a bit unexpected for the stock. Did they pay a dividend? No dividend. Okay, that's good. But yeah, I'd be careful. I'd actually rather own Calmain, and I actually do own this company. It's another pure chicken egg stock, CALM. I own them here in my, I'm down on them. I'm down 6.9%. But yeah, this is a pure chicken egg commodity company. And they're at a 9 forward PE, 6.3% dividend yield, no debt. Oh, that's what I love about this stock right here. The whole company is worth $3.6 billion. So this company is worth $3.6 billion, and they have in cash right now $1.15 billion of cash and no debt. So 30% of what you're paying is just their cash on hand, which is important when you're buying a commodity stock, that they just have no debt and a lot of cash like that. All right. Hey, what's up, Catherine? Happy Mother's Day. Hope everyone's having a good Sunday. So, okay, I'm really behind here. Thoughts on RXT? Let's do RXT right here. And then we'll do weeble and RVLV. I want to get to all these. I'm so sorry if I'm missing some. I got a sparkling water here. Okay, Rackspace Technology. They're up 56% on Friday. Okay. They're worth 1.3 billion, but before Friday, they were only worth under 100 million. So let's go see. Obviously, there's some sort of news I don't know here for them to gap up so rapidly like that. It looks like it was on earnings. So public cloud. Oh, wow, look at that. So they reported earnings and they crushed it. Analysts expected 660. They did 678, but it was really a beat on the net income. So they expected negative 53 mil in net income, and they had a positive 8 million in net income quarter, which technically wasn't real because the core business lost 17 million. So there was like some one-time adjustment. So they didn't actually make 8 million. but they still narrowed their losses by 53%, which is faster than way faster than the small sales growth of 1%. I don't know about this one. It just seems like I'd rather, if I'm wanting exposure to a cloud company, I'd rather just get AWS Cloud, Microsoft Azure Cloud, Google Cloud. I don't know, or maybe even an Oracle. This one seems a bit risky because like the revenue's not growing. I mean, revenue's up 1 after like it's been declining. Yeah, if we just zoom out to the revenue, like yeah, it's down from 2022. So that's why the stock has struggled, and they have a lot of leverage. Look at that. How are they going to pay off this debt right here? So they're not close to profitability yet, and they have $4 billion of debt. Way more debt than assets. So I'd be real careful with that one. But there is a bit of a short-term momentum rally there. Oh, so actually special thanks for that. He says RXT announced a deal with AMD. Pretty cool. Oh, wait, remind me to get back to Nvidia. Okay. Yeah, I want to do Nvidia next. I'm just gonna have to. Someone says stop the China glaze though. Oh, yeah, China stocks historically always trade really cheap and don't grow as much as the U.S. markets. So actually, yeah, let's just do Nvidia really quickly. I'm actually surprised on, yeah, the forward multiple is inexpensive. So a lot of people say like, yeah, Nvidia is at an all-time high. There's probably not much room for them to grow, but I disagree. I think there's still a lot of room for Nvidia to grow simply from a valuation point of view. And hey, Andrew, yeah, thanks for that gift there. If you have a stock you want to look at, let me know. But check this out. The forward PE is a 25, which again, this is a growth company. You don't value them off their current PE, which is price to net income. They currently trade at 43 times net income, but they only trade at 25 times next year's net income. I feel that can stretch up way higher to like a 30, like before it maxes out, and send this up to $240 to a crazy new all-time high. They sell the best GPUs, 24% PC GPU market share, up from 18%. And the future, look at the analyst expectations. This is just what's so great. There's still going to be 100% EPS growth, basically. Net income on the left is going from 26 billion all the way on the right to 46 billion. And that's assuming they don't beat on earnings. So they're going to do 42 billion net income next quarter, 46 billion the quarter after. I mean, that is like if another company can pull off this sort of net income growth. I mean, look at Nvidia's net income. Went from in 2023, 600 million in net income a quarter to now 40 billion plus in net income a quarter. They also deserve to be the world's largest company by market cap. So that's another thing to watch out for, the law of large numbers. Nvidia in the top right is worth 5.2 trillion. If you buy a share of Nvidia right now, for you to double your money, they have to be worth 10.4 trillion. So just from a law of large numbers, it's a tough double. But I still think if you buy Nvidia today, you'll get like S&P 500, like 8% of your money back a year. But I would rather, instead of buying Nvidia at a 5.2 trillion market cap, buy some of the AI infrastructure names. By the companies doing the HVAC work, like Comfort Systems. They do the heating, ventilation, air conditioning for the data centers. By the companies doing the complex MEP work, which is mechanical, electrical, and plumbing for these data centers. The construction industry. I got Powell Industries for that one. By the companies powering the data centers. I own the best nuclear company. I love nuclear and utilities, so I picked Constellation Energy. This company actually owns 33% of all the U.S.'s active nuclear reactors. The purest play for nuclear. There is no close second. I've looked at all of them that existed. I have Amphenol, which supplies the copper cables for NVIDIA's NVLink spine, and Google's custom TPUs uses Amphenol's copper cables. So, and they're only at a 24 forward P. So I just get in the whole industry. All right, next up, how about Microsoft? Yeah, man, let's do Microsoft. They're actually ridiculously cheap. And I actually just bought Microsoft as one of the most recent purchases I did. So here's full transparency. Here's all my most recent purchases in order. And literally just a couple weeks ago, there's the buy order right there. I bought Microsoft for the first time ever at $359 a share. I mean, they were on a historic dip. I mean, they're still cheap even now. So if you're up on Microsoft, don't trim or sell. Don't even trim a little bit, because I think they're going much higher from a valuation point of view. Again, this is why the S&P 500 still has room to grow. We just looked at Nvidia and Meta. Both of them are at dog cheap valuations and can go higher, and Micron and a lot of companies. So Microsoft, and that sounds crazy, but I really think the market's just going to continue to slowly climb higher. We're in the next like roaring 20s, but yeah, look, the forward PE is a 22 on Microsoft. So they only trade at 22 times next year's net income. This is the number one software company, the number two cloud company, and potentially one of the best AI companies. Because if you didn't know, Microsoft literally owns 28% of OpenAI, which is ChatGPT. They're saying OpenAI, ChatGPT is going to replace a bunch of software. Well, that's why Microsoft is hedged. Even as the number one software company, they own Excel, spreadsheet, Word, all that, PowerPoint. They're saying that ChatGPT will replace that, but Microsoft's hedged as the owner of that. And if AI gets really big, AI needs a huge cloud. And Microsoft is the number 2 cloud provider. Their Azure cloud, this does over $100 billion of annual revenue. Their software business also does over $120 billion of annual revenue a year for them. That's why they're also falling, because they're falling with all the software companies like a Salesforce, an Adobe. They're falling with those names, but Microsoft is the best positioned as the one that owns a bunch of OpenAI. Pretty cool. And as the second largest cloud company. So pretty much every company, S&P 500 company, uses Microsoft in one way or another, from Windows PCs to all the software. And they print money. They have a better credit rating than the literal US government. So it's more likely that Microsoft will repay their debt than the US government. Microsoft does $30 billion of net income plus a quarter. And that's what analysts are projecting for the future. There's the number from S&P Global Analyst. It's supposed to be $31 billion next quarter, $34 billion the quarter after. So growth isn't gone. It's just the only thing hurting Microsoft is sentiment. And I'm not being scared out of Microsoft. Actually, I'm buying more Microsoft because they're so great. How about Palantir? Yeah, Andrew, thanks again for that gift there. Let's check out Palantir. This is one of the top defense stocks on the market. So half of their revenue comes from the government. A ton of police stations, the military, the Air Force, even this is why they're being protested. They're actually, ICE is a customer. So they have insane government revenue growth. So yeah, here's the numbers. Government's half of their revenue. And check out the growth rates. This is why Palantir is an absolute monster, and I salute them. Revenue is up 76% year over year. After it grew 45, after it grew 16. So the growth rate is growing on their revenue. And this is all organic. They didn't acquire a company to inorganically grow this. This is just the real fundamentals growing themselves. And the other half of the revenue comes from their commercial side, from companies like GE Aerospace and Google. That does the growth rate is up 95 and nearly doubled. Up 95% after grew 33, after grew 31, after grew 18. So Palantir is just on a streak of growth, crushing analyst expectations. The orange line is what the analysts expect every quarter. Notice they beat every quarter by a huge gap. They expected 616. They did 870. It's actually ridiculous. So their net margin's a 53%. Now, margin expansion story. Net margin went from 25 to 53. They're practically collecting royalties at this point. Plus another cherry on top, big safety net. They have no debt. They're literally debt-free. $8 billion of cash, earning interest. So the only thing that sucks about Palantir is that they're expensive. There's literally nothing bad I can say about this company except that they're expensive at a 91 forward PE. So it's a company I would love to own, just at a cheaper valuation. I will own that company. I used to own them. Oh, if y'all want to see a huge L, I'll show you where I sold Palantir. Y'all won't believe it. I sold it very cheap, and it's one of my biggest regrets ever. Some of your biggest regrets will be selling out of great companies. But yeah, I sold Palantir at $8.29. I bought it at $7.40, sold it at $8, and now it's $137 RIP. All right, next up here, let's do BE. I think this is Bloom Energy. Then we'll do Lockheed Martin. And I apologize. I got to get to... I'm a little behind here on the chat. If y'all are enjoying, please leave a like on the stream. I stream every Sunday this exact same time. And Bloom Energy, this is an alternative energy storage business. I think they do like silicon oxide batteries or something. Oh, wow. So Oracle is partnering with Bloom Energy for a 2.8 gigawatt fuel cell power New Mexico data center. Cool. So revenue up 130%. Let's go see what they reported versus what the analysts expected. Oh, wow. This was a gangbuster quarter. Holy moly. Look at this. So analysts expected 540 mil of revenue. They did 750. They beat by $210 million. And then if we go to the net income, analysts were projecting them to lose $600,000, and they came out and made $70 million. And that was real. Oh, for a second, I didn't know if it was some gap, a one-time adjustment, but no, that's real EBITDA. That's real net income they made. So it was a real organic beat. So no wonder they gapped up so much on earnings. They earned it, Sorry, I'm lagging a little bit here. I apologize if the stream's lagging. Yeah, dang, the kilobytes just got cooked. Okay, it says we're back. Okay, sorry if it lagged. We're actually good now. But yeah, it looks like the new Oracle partnership is real bullish for them. Unfortunately, okay. Thank you to everyone that's still here. I don't know what's going on, but I'm gonna reset my. There we go. Okay, I'm gonna reset my screencast here. See if that fixes it. Okay. Oh, it says we're fully back now. Okay, we're fully back. The kilobytes are back. Sorry if it lagged. Okay, thank you. Bloom Energy right here. Anyway, they had some really good earnings. I can totally see why they gapped up. They deserved it. They earned it because those numbers were really good. So yeah, okay, we're fully back. Sorry for the lag that happened there. Okay, yeah. RIP. So AJ said Uber stock. This is one of my favorite stocks in the whole market right now. They just acquired a bunch of great companies like Spot Hero. It's a parking spot app, and they own a bunch of stakes in a bunch of different stocks. Actually, let me pull that up. I had a post of it on my Discord. Random news. So yeah, here's everything that Uber owns. So Uber owns a stake of Grab, Aurora Innovation shares, Lucid shares, WeRide, Joby Aviation, Serve Robotics, and MQ, which is Marqeta stock, MQ. So Uber invests a ton of money into a bunch of different publicly traded stocks. Uber targets expansion to up to 15 autonomous vehicle cities by end of 2026. So yeah, this is a cool AV play, like autonomous vehicle play, where it's the platform you go to book and like a robo-taxi on where you make the money. And check this out, because Uber has the users. Uber has 202 million monthly active consumers. So not just monthly active users, but actual consumers who spend money on their products and services. So when we go to their ride-sharing revenue, the mobility revenue, that grew 4.65% year over year. After grew 15, after grew 34, after grew 120. So they're on a streak of growth. And the real growthy business has actually been the delivery side. That grew 35% year over year to $5 billion. This is the highest growth rate on the entire screen, 34%. Yeah, it's never even been close to that before. So incredible growth on Uber's side there. And check out the profits here. They're the most profitable they've ever been. So yeah, someone said in the chat, yeah, no dividend on Uber, but that's okay because they do share buybacks and they invest in a ton of different companies, which is arguably a better way for them to return you money as a shareholder by doing things that are accretive to the EPS and makes the stock price go up more. So yeah, they've never been more profitable. This is the most profitable quarter they've ever had. And same with FCF, which is free cash flow. No wonder they invest so much in a bunch of the companies, because they have $2 to $3 billion of extra free cash flow to play with a quarter. They have no net debt, so they don't have any debt to pay, so they just invest it all. It's genius. So great software company, and the valuation isn't expensive. Uber only trades at a 20 forward PE, which means Uber trades at 20 times next year's net income. That is ridiculously cheap. And I do own some Uber shares here in my Weeble portfolio. They're one of my most recent purchases. Here's where I bought, literally for the first time ever, I bought them just a few weeks ago. I bought 12 shares and I've just been holding ever since. And if they keep falling, like they just reported really good earnings, if they keep falling, I might actually buy a little more shares as well, because I'm just really impressed with them. Hey, what's up, Yashindi and Carlos? What do you think of EOSE? Yeah, then we get to Marathon as well. EOSE. What is this one? EOSE and EOS Energy. Okay, I know I'm behind here. I'm so sorry to everyone if I'm missing your stock and stuff. Like I see Zoom. Hey, what's up, Billy? I want to get to Zoom. They have a cool Anthropic investment and GS and Revolve. Okay, so here's EOS Energy, a $2.7 billion company. They were up 25% on Friday. So this stock is lower than it was when they IPO'd in 2020. What do they do? Product and service revenue. Electrical equipment. So it designs, manufactures, and deploys battery storage solutions. Okay, so it's kind of a commodity if they just sell like batteries. But let's go see how they're doing and see if they have a net margin. I'd be curious to see. So yeah, they don't make any money, but the sales have exploded. Whoa, look at this. So you're buying this company as they're converting from doing, 10 mil a quarter to potentially doing 50 mil a quarter, which is 200 mil plus a year. They are highly, highly leveraged. They have more debt than the whole entire market cap. And yeah, I don't know how they're going to pay off that liabilities when, look, dang, they lost 120 mil, 650 mil, 200 mil, 15 mil, 200 mil. So they lose a lot of money. So, and that's why the liabilities go up every quarter. Whenever you lose $600 million, and you don't make money, that money has to come from somewhere. So the liabilities and the debt goes up by a bunch. Yeah, and they're having to issue shares. I would be very careful. Yeah, negative cash flows, negative net income, but good revenue growth. So it's a tough story. It's a tough one. Not one I trust too much money in. There is a lot of risk there, but it's really interesting. Marathon, this one is a company that is a Bitcoin mining company. And I think they're slowly converting to like a cloud company. But historically, this one has underperformed actual Bitcoin. Like, if you just want to trade this one for Bitcoin, I'd rather own actual Bitcoin. And let me just share with you that right here. So I think you really just value this one off the NAV, the net asset value of all their Bitcoin. But yeah, here's the money they lose. Dang. So all they've kind of done since inception is just lost like a couple $100 million a quarter. So I would just be so careful with this one. It's kind of just like a high beta Bitcoin, kind of like a micro strategy, but they don't make any money. They lose a lot of money and it's tough. Revenue projections are negative. So revenue's going from 240 to 180. And look how much they missed on earnings this quarter. They expected 250, they did 202. And they were expected to lose 500 mil. They lost 1.7 billion. So yeah, not one that's really blowing me away here, you know, unfortunately. So what are these? Wrecker Systems. Hey, what's the ticker symbol for that stock? What is VSAT? So Viasat stock. Wow. A lot of the like space companies, the satellite stocks, like have been rallying ever since the SpaceX IPO in like the Artemis mission launch mission. So let's see how they're doing. And I think this is like a satellite Wi-Fi provider. I don't remember exactly, but they've been on fire. So communication services and defense and advanced technologies. That's interesting. So that's up 9%. Communications up 0.6. So how they beat on net income this quarter. They were expected to lose 33 mil. They made 25 mil. Is that real? Yeah, it was. They really did make a profit this quarter. So congrats to them. But the revenue growth has just been really slow. It's kind of just been growing low single digits. I wonder, did they do an acquisition back here? I don't know. Yeah, you know, I don't think this rally is really justified. There is no forward PE. Like, they're not expected to make any net income. Yeah, because next quarter, analysts expect them to lose 45 mil, then lose 70 mil. So I don't know what is actually justifying this appreciation of the stock. Maybe there's some news I'm missing. I don't know. But something to look into. All right. Where can I learn fundamentals? Or hey, I guess the only way to learn from me is just watch my streams and YouTube videos. I sell nothing. I have no course. I don't teach. No book. If y'all want to hit the follow button, I greatly appreciate that. I try and stream all the time. The only way to learn, I guess, is watch the streams and the YouTube videos. But hey, thanks for that. I appreciate you. Actually, I have some YouTube videos as well where I go over like how I analyze a stock, what metrics I look at. My YouTube channel is called Nathan Robert, if you'd like to go. So yeah. So here's Goldman Sachs right here. That's Moomoo Premium. No, hey, what I'm on right now, I'm on an app called Moomoo. The only features where you have to have Moomoo Premium, and to get Moomoo Premium, all you have to do is just have $100 in your account. The only thing that you need is the thing that says member next to it. So Morningstar research you can't see unless you have $100 deposited in analyst rating. But all the metrics that I've been looking at this whole stream, like all these things, there's no member next to it. Anyone could see this. So yeah, if you'd like to get this app, you don't have to deposit any money. It's completely free. It's in my link profile there on my description. But if you end up depositing $100, we'll both get some free stocks, and you get like these extra, like, I don't really look at it much, but like the Morningstar research or whatever, where you can read like, hey, what did the bulls say about the stock? And what did the bears say about it? Anyway, let's go look at Goldman Sachs, though. This is a bank right here, one of the top banks in the U.S., too big to fail. And it's like a dividend growth value stock. You know, the valuation is pretty decent. They're at a 15 forward PE, which means they trade at 15 times next year's net income. And the coolest part is, if you buy Goldman Sachs, even right now at current prices, you get a 1.66% dividend yield. So you're getting 1.7% of your money back just in a qualified dividend every year, not including the stock price appreciation. And Goldman Sachs also has an asset and wealth management business, which I love because they just collect high margin fees every year off the assets they manage. So here's their bottom line. Their after-tax net income. They're a money printer. I mean, they're making $4 to $5 billion. This quarter specifically was really good, like literally 4 to 5 billion of after-tax net income a quarter and a good dividend. So JP Morgan, Goldman Sachs, they're both really good. American Express. I know Warren Buffett likes these kind of stocks too. Yeah, if we go to the Buffett portfolio, he got American Express as the second largest holding, and then 8% of his portfolio is in Bank of America or BOFA. So yeah. So let's keep looking at some more stocks here. Let's see. Oh yeah, JP. Yeah, someone said JP Morgan in the chat as well. Yeah, JP Morgan, pretty similar business model to Goldman Sachs. The charts almost look identical. Yeah, JP Morgan, you buy this one right now, you actually get a slightly higher dividend. You get a 2% dividend on JP Morgan, and check out how much net income they make. JP Morgan, did you know this is their after-tax net income? They make 14 billion in net income a quarter on average, or sometimes more. Pretty ridiculous. So that's why these banks just make so much money. They pay out dividends, they do share buybacks, they invest in the future. A big fan of them. Next up here. What about Intel? Yeah, Intel, they just got a big deal. Like AMD, Intel, these stocks have been mooning because Apple and Nvidia have both agreed to move some manufacturing away from Taiwan Semiconductor and move it to Intel. So it's part of their way for them. Basically, these companies have promised to like invest a bunch of money in the US. And one of the ways they're kind of allowed to do that is by moving some of their manufacturing to Intel and causing that economic GDP growth here. So, and yeah, the third line here, Intel and Apple reach a preliminary chip manufacturing agreement with U.S. government support. Pretty cool. The U.S. government holds a 10% stake in Intel following a $9 billion investment in 2024. The U.S. bought 10% of them for $9 billion. That 10% stake today is worth $62.7 billion. Wow. Pretty crazy. Anyway, would I buy Intel now? No. Certainly pricey at a 200 forward PE. I'd rather actually buy an Nvidia or an Apple. I'd actually rather buy the companies, moving the manufacturing to them. Nvidia, surprisingly, is only at a 25 forward PE. Like the largest company in the US by market cap is only at a 25 forward PE. That's why I think the S&P 500 can still go up a little more. Nvidia's cheap. Microsoft's at a 22. Meta's at a 19. Like these can stretch higher really easily. Not financial advice, of course. So RVLV, what is this one? RVLV, Revolve Group. Okay. There's another company called ASTS and EchoStar. Oh, yeah. There's another one. It's the one that partners with Google. Planet Labs. Let's look at that one next, maybe. PL. Okay. So is the deal going to hurt Taiwan Semi? It shouldn't really hurt Taiwan Semiconductor long term, but that is one of the reasons. All right, Taiwan Semi is still doing amazing. But a lot of people have been saying that Intel's market cap, market cap should be taken away from Taiwan Semi and go directly to Intel. It's kind of the thesis there. So here's Revolve Group. I'm actually not sure what this company does. They're worth 1.49 billion, so they're not too huge. Let's see what they do though. Internet retail. Oh, so is it just like an online, like almost like an Amazon, but just for like clothes? So I guess here's their website right here. So I'm not too big of a fan of these kind of stocks. I bet it's low margin. Let's see what their net margin is. So they run, low single digit margin, but still a profitable company. They're still making 13 to 20 million in net income a quarter. So not too shabby, but it's just kind of like, what's the moat here? Like if you like this company, maybe you'd rather own Amazon, but yeah, they're only at they trade at 23 times net income. That might be expensive given the industry, but this whole industry is just struggling right now. If you look at like a Nike, an Under Armour, a Lululemon, they're all kind of struggling right now. Yeah, Lululemon, check out this stock right here. They're the same prices they were back in 2018. Yeah, dang, these clothing stocks have been a real struggle. But it's not just one company, it's kind of the whole industry. Hey, what's up, Looney Zone? Hope you're having a great Sunday. Hope everyone's having a great Sunday. Happy Mother's Day. If y'all want to hit the like button, I greatly appreciate that. Hit the follow button. We stream every Sunday this exact same time, and I sell nothing, no course book, just on your gift, my opinion. So here's Corning. This is a cool fiber optics company that just had a big deal with Meta and I believe someone else. Yeah, Nvidia. So Corning and Nvidia formed strategic partnership to expand U.S. optical manufacturing capacity tenfold for AI infrastructure. So yeah, basically a pure AI infrastructure company. Another cool thing this company does is they make Gorilla Glass for Apple's phones. So they make the displays. So yeah, if we go to Glass Innovations, 35% of the revenue is actually the Gorilla Glass for iPhones. Kind of cool. But yeah, optical communications, this fiber optics business has really been the best growthiest driver recently. And if we go to the revenue, check out this margin expansion. The revenue is up by 20. So revenue's up 20. The profits are up by 43. So that means margin expansion. Pretty cool. But it's really the future growth expectations. Like they just got this new Nvidia partnership and Meta partnership just in the past like month and a half, which is going to revise their future earnings up higher. Hey, someone, or who said that? Yo, Midnight Talker, thanks, man. He says you were awesome. I appreciate you, man. What app is this? Yeah, hey, this is an app. It's a brokerage called Moomoo where you buy stocks on. If you'd like to get it, I have an affiliate link in my link profile description there. Kind of the description. We can just type into Google, brokerage called Moomoo. Next up, we already looked at SoFi. Maybe we'll look at SoFi a little later. Oh, wait, yeah, Planet Labs. This is that satellite company with a big partnership with Google Maps. So the really cool thing is if you just go to shareholders on this company, Alphabet owns 10% of all the shares, and Alphabet is literally just Google. So Google is the largest shareholder of this company. Planet.com is their website. They own these Pelican satellites that make it, like 10 years ago, the technology was really bad, but then Google partnered with them. And now when you go on Google Maps and you zoom in, you can really look deeper and you can like visually see stuff a lot more higher quality. So that's basically what they do. Geoscanning, satellite, stuff like that. So yeah, that's Planet Lab with the backing of Google and that Google Maps partnership. CHTR, that's another one I think. Charter. Oh wait, we just looked at this stock. Yeah, Charter Communications. I think there's just a lot of competition. What does Charter Communications do? Telecom services. Okay, so I'm assuming the revenue's just kind of slowly declining. Yeah, so look at this right here. So the revenue isn't going to grow much anymore. It's kind of just going to slowly decline single digits as people just don't sign up for cable anymore. But they still make good net income. This company still makes over 1.3 billion of net income a quarter, but it's just a future growth story. Like there is no growth, and that's what the market wants, like a growth story. So yeah, look at that. They trade at 4 times net income. So companies with no growth or negative growth, when they're expected to have negative growth, you just trade at such a low multiple. The market doesn't give them any credit. So, I don't know about this one. I mean, how much cheaper can the valuation go? I don't know. But I just, I don't know about this one. Like Spectrum TV is what they own. Spectrum, yeah. So I don't know. just like modems and stuff. Kind of a commodity. Kind of reminds me like a Comcast too. Comcast. Zoom, please, breaking out for long. Yeah, I saw that one earlier. My bad. Let me get to Zoom and then we'll do I'm a DCing and Nvidia. Yeah, we'll look at some of these other ones like ENVA. Just like and subscribe. Hey, DTAB, dude, thank you very much, man. Thanks for supporting the YouTube stream. So here's Zoom. They actually are rallying because of a stake of Anthropic they made. They actually have one of the most like best investments ever. Oh, it's not on the news anymore. But on my last stream, it was down there. Zoom spent $51 million buying Anthropic back in 2021. So 5 years ago, they spent $50 million buying Anthropic before it was popular. That stake today is worth over $2 billion. So from 50 million to 2 billion, because Anthropic is now worth at $1 trillion. And sitting around, so it's pretty crazy. Because Zoom is a total commodity, Zoom, the core software, there's Microsoft Teams and all this other stuff. So it's a total commodity, low margin. But I love that they have no debt in that investment that they have. So they're too cheap to sell. So they have 8 billion of cash. Zoom has literally 8 billion of cash and no debt. Did you know that? And the whole company is worth 32 billion. So 25% of what you're paying, even now, it's just their cash on hand. But that being said, I really wouldn't trust Zoom too much. I am down 30% on my Zoom position. I have been holding this one since 2021. I mean, I have been like, look, there's some of my buy orders. Like, isn't that crazy back in 2022? So I've just been down bad on this one, but they're too cheap for me to fully sell out of. Sometimes if you're down on a stock, it sometimes totally makes sense to fully sell out of them. But in this case, it does not make sense to sell out of Zoom. I'm just going to hold on to my shares. Actually, I kind of like that they have no debt in that investment. Hey, Seek Truth, dude, thanks again for that gift. I appreciate you. He said, or maybe she said, zscaler, I appreciate you. This is a cool software kind of cybersecurity company. They're just struggling with profitability right now, and they're falling with all the software stocks. So let's see if there's any specific news. Zscaler, okay. Let's actually, is there an earnings hub I can get off this? Okay, so cloud security revenue is projected to grow robustly, supported by AI-driven solutions. Billings are expected to rise substantially, reflecting strong customer demand. Operational efficiency improvements. Okay, so yeah, here's the one bad part about them is that they don't have like look, they don't make money yet. Like in the losses actually kind of just worsened year over year. So they're still losing a bit of money, but they're not losing that much, like 20 to 30 million dollars, no big deal, especially if they keep growing at this clip. I mean, every quarter their revenue hits a new record. That is super impressive. Like not like just every year, but literally every quarter the revenue hits a new record. So hats off to them for the revenue growth. But I just would like them to actually get profitable. So when we go to a forward PE, it's kind of hard to value them because there is no forward PE. It's negative because they lose net income. So actually, Morningstar gives them a 5-star undervalued rating. They said they're undervalued, accelerating enterprise adoption of zero trust architecture, the secular convergence of networking and security, and increasing cybersecurity demand driven by new AI models will drive long-term growth. Cool. Yeah, the stream is currently offline, it says. Please, okay. It's back, kinda. Oh, man. I apologize for the lag today. This, like, never happens, so I don't know what to do. But I appreciate everyone that's here. If you can still hear me, please leave a like on the stream. I greatly appreciate that. It says we're back now. Okay, it says 10,000 kilobytes. I think we're back. No more lagging. Okay, sorry if it lagged there. Hey, what's up, Looney? Plasma. Good to see you, Plasma. Hope everyone's having a great Sunday. Happy Mother's Day. Sorry about the lag. We're fully back now. So do you like SEHD or VOO more? I like VOO more. Definitely in the long term. This is a more dividend-focused ETF. So this one historically doesn't perform as well as the S&P 500 does, but you buy SEHD if you want a little bit more income. If you're like close to retirement or something, this ETF gives you a 3.4% dividend yield, which is much higher than the S&P 500's 1% dividend, or it might be slightly more than that. But yeah, so you get the 3.3% dividend, and they own a bunch of the higher yielding names, like a Qualcomm, a United Healthcare, a Coca-Cola, a Chevron, Verizon, a lot of Buffett type stocks, actually, yeah, if we pull up the Buffett portfolio right here, he owns a bunch of Coca-Cola and Chevron. So same holdings. So I see Neo and Digital Turbine. Hey, what's Digital Turbine? Inostar said, what application are you using? Yeah, this application I'm using is actually in the link in the description on the YouTube stream. It's in the link in my profile on TikTok. So actually, I'm a little behind here. Let me do ENVA, then we'll do GE Aerospace and some of these other ones. So, wow, congrats if you own eNova. I've actually not heard of this one. And yeah, no problem there, Billy. Yeah, hopefully Zoom does rebound. Yeah, eNova, they're at an all-time high right now. So if you've ever bought this stock, you're definitely up on your money. So congratulations. Let's see what they actually do. Wow, the forward PE is a 10. So even though they're at an all-time high, they only traded a 10 forward PE. This implies to me that they are just going to continue to climb higher. This forward PE can easily stretch up more. What industry are they in? So they're in consumer loans and finance receivable revenues, small business loans. Interesting. Wow. The small business loan is up 37 after grew 28. Consumer loans up 3.5 after 18. So it's really their small business loans that are growing like crazy. And it's not just the revenue that's growing either, it's the real after-tax net income. If we zoom out, this is basically the most profitable quarter they've ever had. 91 million of after-tax net income. It grew 25% after it grew 50%. And that they're rocking a 10% net margin as well. So pretty cool. It's just like a loaning company. Let's go to their website right here. eNova right here. 70 billion, 15 million customers, 1,500 employees. Cool. 39 of Americans said they cannot cover an emergency of $400. Is that statistic true? I wonder if that is. Dang. Emergency $400 expenses. Okay. Let's keep going. Maybe some sort of loaning company. Yeah, small business loan. UFO ETF. What is the UFO ETF? So the Procure Space ETF. Oh, yeah, I bet this one has been booming because all like the SpaceX IPO, the Artemis launch mission has been sending momentum across the whole industry. So, yeah, Planet Labs, largest holding, Viasat, Global Star, which is being acquired by Amazon. So, that's why the chart looks kind of weird and flat because Amazon is actually buying that company. SiriusXM, Rocket Lab has done great. Trimble, what's that company? I've not heard of them. They haven't done too well. But cool ETF there. Thanks for that. Yeah, I agree. I like VO more. Yeah. Hey, Huffs. Oh, Logan, remind me to get to Celsius. We'll look at Celsius next. I saw Berkshire Hathaway, BRK.B. This is like a S&P 500 alternative. So if you like the S&P 500, this is another one that's great. It's very diversified, but it's also not at an all-time high. If you look at the S&P 500, it's at an all-time high. And this one is still a good 10-15% off all-time highs. So that is one thing to watch. But I love the brands and businesses that they own. They own Geico, like they wholly own some companies, and then they own a bunch of stakes and a bunch of stocks. So yeah, they wholly own Geico, which is this insurance business that does over just that. Geico does $100 billion of revenue a year for them. They're in manufacturing. They own Pilot, the gas station. They own BNSF Railroad. So I really love Berkshire Hathaway, an ETF in one. And here's what they own as well. They own a big stake in Apple. Here's what it is exactly. They own Apple, American Express, Coca-Cola, Bank of America, all these names here. They just bought Google. That's 2.2% of their holdings. So pretty cool. So next up is Celsius. Oh yeah, then GE Aerospace. I'm all over the place today. I apologize. So Celsius, this is a great energy drink company. So it's kind of like a Monster beverage competitor. So they own Celsius, they own Alani, and they own Rockstar Beverage. So they own all three of those brands. And the forward PE is why I really am a fan of this stock because they currently look really expensive on the left at a 75 PE, but they had a one-time adjustment hurting their earnings. And if you didn't know that, you'd think they're really expensive, but they're actually not. They only trade at 20 times next year's net income. And here's the net income projections. They're going to make 99 mil next quarter and then 108 million the quarter after. So yeah, this is the one-time adjustment I'm talking about. You see how it says they lost 61 mil in net income? They didn't actually. The core business made 166 million. They just moved their distribution network to PepsiCo, and they had a one-time termination gap adjustment to their net income. So artificially hurting their current net in EPS. So anyway, that's why you look at the forward PE. I'm a big fan of Celsius, and actually current prices look very good. And especially if Monster just crushed earnings. Monster Beverage just rallied up like crazy on Friday to a new all-time high. So they just hit an all-time high on Friday. I actually own the Coca-Cola and Monster bottling company. It's called Coca-Cola Consolidated. They're the largest bottler in America. They mainly bottle for Coca-Cola and they bottle for Monster and Dr. Pepper and kombucha tea. So they're just pretty cool, I think. So RSP, I think that's the equal weight S&P 500. So this is actually a pretty cool ETF. So as we know, the actual S&P 500 is market cap weighted, which means like Nvidia is the largest holding since it's the largest market cap at 5.4 trillion. But this one is just equal weighting where every company gets an equal weighting. It changes because they have to update it at the end of the month. But yeah, look at this. It kind of every holding is supposed to be 0.3% of the ETF of the S&P 500. So yeah, you kind of compare that with the actual S&P 500 to see if there's a gap between the top largest holdings doing the majority of the returns. Oh, we got to do applovin next. So Paul, good idea here. He said, can we look at Arista Networks? I almost promised this company will impress you. And I can see why they have just had crazy stock price appreciation. They deserve it because the fundamentals have grown with the stock price. Y'all will like this. Especially if you're going to diamond hand a stock, you want to see a company with growth like this. So if we just go to revenue right here, just organic revenue. Oh my goodness. They're saying I'm AFK. Hold on here. Okay. Sorry if the stream just went down for a second. They thought I was AFK. But anyway, here we go. Look at this revenue growth. And this is organic. They didn't acquire a company to get this. Revenue is up 35% year over year. So that's the revenue. What about the actual net income, the after-tax net income? It's even more impressive, or it's just as impressive. It hit a record 1 billion of after-tax net income for the first time ever. So record net income. And at this growth rate, what is the net income going to be at this same time next year? So, or we can see the analyst projections. It's supposed to hit 1.04 bill, 1.07 bill, and they beat on earnings every quarter too, or they beat like crazy this past 2 quarters. So that's why I'm a fan of Arista Networks. They're selling these like data center infrastructure stocks where they sell these like antennas so these data centers can communicate and send data to each other, which is really popular. From one data center to another, they put these antennas on them. So that's apparently what they're doing, something like that. So Morningstar says they're undervalued. Soaring demand for AI infrastructure and a steady market share gains in high-speed data center switching will drive long-term value growth. Pretty cool. And it looks like they had a little bit of a gap down recently on earnings. Maybe they gave bad guidance or something. I don't know. Can we see that? Let's see. Raises full year guidance to 11 billion. Arista Networks, okay, warns of industry-wide component shortage and supply chain pressures affecting gross margins. So maybe they'll actually get to raise prices. Management expects supply constraints and gross margin pressures to persist for 1 or 2 years. Okay, so they had a 1% decline in gross margins, so that might be why the stock fell, but they fell by 20%. I think that's a bit overdoing it. So I have hey, Jimbo, great recommendation here. There's another software stock I just bought for the first time ever. I know it doesn't pay a dividend, but the fundamentals make up for it. So when all the software stocks were tanking the past couple months, like this one fell from 730 to 350. This one was no exception. So I actually just bought applovin for the first time ever just a couple weeks ago because of how impressive they are. You won't believe this. I didn't believe it either, but it's real. Check this out. Revenue is up 58%, or all organic, of course. Revenue is up 58%, and the revenue is 1.84 billion. On this 1.84 billion of revenue, they kept after paying taxes, 1.21 billion, which means their net margin is a 65%. So you go spend $100 with them, they keep $65 after paying taxes. Yeah, here's the before tax number. Before tax was 1.44, after tax was 1.21. And the free cash flow is more impressive. They did 1.3 billion of free cash flow. So every time this company receives $100, $70 of that is free cash flow and $65 of it is after tax net income. They're basically collecting royalties, and the growth is not done here. Here's what the analysts expecting. Net income is supposed to hit 1.26 billion next quarter, and then 1.4 billion the quarter after. That's still massive EPS growth, going from 800 mil of net income to 1.4 billion. So you judge this one off next year's net income as a multiple, because it's a growth company, and so they only trade at 26 times next year's net income. That is why I am such a big fan of applovin, and that's why I also just bought them for the first time ever, about 1.5 shares. I'm always a fan of buying fractional shares, no harm in that. Always just want to up your quantity. Yeah, there's my little buy order. So yeah, I just bought applovin for the first time. Out of all the software stocks, I'm like, I want to buy a software company that's on a dip, but also one that prints net income and prints free cash flow and has great fundamentals and margins. So it's an advertising software company. And hey, Junior, thanks for the free or the freestyle machine gift there. I appreciate that. If you got a stock you want me to look at, let me know. Charge your phone. Yeah, dang, my phone's getting low here. Luckily the last percent lasts a little longer. Hey, what's up, No Name? We're ready for a big dip this week, guy. Hey, I would love a dip to actually finally be able to buy stuff, because a lot of complaints right now are that, the market's at an all-time high. All the good companies you really want to buy and get exposure to are too expensive, like Comfort Systems and a lot of these AI infrastructure stocks. They're all at crazy valuations that are just too hard to buy. So I would like a dip personally, but at the same time, like I don't want to see my own stocks fall. But yeah. Okay. Hey, Josh, what's up, man? Hope you're having a great day. Medline. Yeah, let me find that one for you. I think that was a kind of recent IPO. Yeah, check that out, Medline. So this is like one of the medical device delivery businesses or something like that. Let's see. So they're not expensive at a 21 forward PE. So they do supply chain solutions in Medline brand. Anyway, here's their net income. It's really good. It's like 300 to 200 million of net income a quarter, but the margins fell. So the revenue grew 10. So revenue's up by 10, but the profits are down by 25, which is real. So check out the gross margins. Gross margins fell by 9. Net margins fell by 30 to a 3% net margin. So that might be why the stock is falling. and gap down on the past two earnings reports in a row. They fell on earnings. I think that might be why. Yes, I mean, that's what analysts expected. I mean, they only missed by $10 million on net income. So it's just a margin issue, I think, that's happening right now. So 21 forward PE. Let's check out their website right here to maybe get it better. Oh, I'm not gonna, okay. Yeah, so they remind me of like a Cardinal Health. So anyway, supply chain resilience. They like send stuff from one place to another. Next day delivery to 95% of US customers. So anyway, there we go. They're just like a CAH. Let me actually pull up Cardinal Health. It's a low margin business model. Yeah, like, so it's not just them that's falling. Look at them. The stocks charts actually look kind of similar on a similar downtrend. Cardinal Health also, they run at a very low net margin. Look at this. Like, even though their net margins is 0.6, that still makes them 380 million. It's one of the lowest margin businesses ever. Like, the total revenue is 60 bill. On that, they keep 380 bill. Kind of funny, but makes them enough money. So Comcast, you're not gonna. Okay, let's do Comcast. You're not probably gonna like what I have to say because the underlying business on Comcast is slowly declining. So it's kind of just like a TV cable business that's slowly declining single digits. But yeah, Comcast is the same price that they were back in 2013. So you bought the stock over a decade ago. You're slightly down on your position now, unfortunately. And they trade at 8.5 times net income. So 8 times net income. And that's because their main business is slowly declining. Yeah, residential connectivity. So yeah, as you can see, the year-over-year growth rate's in the middle. As you can see, it's all red, kind of declining single digits. So it's the growth story is gone on Comcast. But what I do like about Comcast is they're kind of diversifying away. They own some studios. So if you heard of like Despicable Me, they own the whole Despicable Me franchise. And they make movies. And oh yeah, theme parks as well, like Universal Studios. I think that has Legoland there in Orlando. They own some theme parks. But yeah, it's the reason the stock is struggling is this main residential connectivity business that's struggling. But they do have a safe dividend, a 5.2% dividend. But yeah, it's just the growth story. So check this out. Ooh, this is bad and this is real. Revenue is up by 5. So revenue's up by 5 and the profits are down by 26. And that is real, unfortunately. So gross margins fell by 9, net margins fell by 30. So I can now understand why the stock is struggling and it trades at such a low multiple. Low single-digit growth on their main business and margin decline. Nothing's blowing me away there. But that all might be priced in. Like, that might be why the stock is so cheap. So maybe that, like, every sane analyst already knows that. So maybe that's all priced in. So it's just kind of, you can kind of make your own thesis there. FNS, he said, NOC, Northrop Grumman. This is a cool aerospace and defense company. So, hey, thanks, Jimbo. I appreciate you. You think fixes will go down? Maybe not in the long run. Long term, Aaron, that one's a really good one. Hey, Caffrey D, thanks for those gifts there. I appreciate you. So here's Northrop Grumman. I really am a fan of the aerospace and defense industry. I wonder why they fell on earnings. Did they miss? So they beat on revenue, beat on net income, beat on EPS. I bet slightly missed on EBITDA. I mean, maybe it was like a future, I don't know. Maybe it's just like a, I don't know, bad guidance. Maybe it was bad guidance I didn't see. So kind of slow revenue growth. So the revenue year over year only grew 4.3. That's still faster than inflation, but 4.3% revenue growth isn't huge. And but the profits grew 72%. So margins are up. They really do. Oh, so I guess here the profits have kind of been flat since 2021. Like they kind of make, or let's go to an annual basis here. On an annual basis, they're kind of making the same profit as they were for the past couple years. So that might be it. The low growth, that might be it. But they have a nice dividend, a 1.68% dividend yield. They actually look very similar to Lockheed Martin. Lockheed Martin is on a similar, look at that downtrend. So maybe it's just an industry-wide kind of sell-off. My aerospace and defense name is Moog right here. My most recent purchase, actually. MOG.A. They're very diversified. Space and defense, industrial, which is data centers, commercial aircraft repair, and military aircraft. They make they do the remote control homing sensors on missiles. They have the patent on that. They have the best patents ever They have over 1,500 registered patents. Their valves and components are used on every single satellite and mission launch. Even the Voyager spacecraft still in space uses their patented valves and stuff. So I'm a big fan of that one. Great stream as always. Hey, thanks, Jonathan. I appreciate you. Thanks for showing up. Can you look at abbvie next? Ooh, what are some of your risky 10x stocks you're thinking about buying in the coming weeks? That's a good question too. I need a real dip to see some. I'll come back to that question there. But someone said, can we look at abbvie? That's one of my favorite stocks to actually buy now. I'm down 8% on my position. Here's my 3 shares. The blue line is where I bought my shares at. You can get in at an 8.3% lower cost than me. And this is a great dividend stock. So everyone who likes dividends, this is one of the best ones in my opinion. That has a high yield, that's sustainable, and it'll give you stock price appreciation. So if you look in the very middle of my screen, they have a 3.4% dividend yield. So you buy abbvie right now, no matter what, you're getting 3.4% of your money back in a qualified dividend every year. And here's why I believe on top of that, on top of the 3.5% dividend, you're going to get 4 to 5% stock price appreciation as well for an 8% total return a year. Here's my own thesis. First off, the valuation is cheap. They only traded a 21 forward PE. So 21 times forward net income, that's like cheaper than the S&P 500. And here's why I think that's cheap. Because the main businesses are growing like a beast. Skyrizi, their largest prescription, this company sells a bunch of different prescriptions. This one is up 32% year over year. After grew 58, after grew 52, after grew 85. These are the year over year growth rates in the middle. It's always growing like 60, 50%. And that's just one prescription. Their next largest prescription, which is Rinvoq or however you pronounce it, check out the growth as well. Up 30, after grew 46, after grew 59, after grew 56. This is why, in my opinion, they're going to also get the 3 to 4% stock price appreciation on top of the 4% dividend because their largest prescriptions are growing like crazy. Like, I don't know, there's a bunch of them, like Botox Therapeutics. That one's up 13% after 12, after 7, almost at $1 billion. Imberclaw, that one's down 20%. What was that one? Imberclaw, or I don't know. Anyway, I'm a big fan of this one. Only at a 21 forward PE. It's a dividend growth company. So yeah. Next up, yeah. Hey, what's up, Monkey D. Luffy? So Rohan, oh, I'm so behind on the chat here. Can you look at NU? I think it looks like a solid investment. Look, let me get to NU. Then we'll get to Fox, or yeah, hey Luffy, do you want me to look at Eli Lilly or Fox? That's a cool one. So here's NU. This is a crypto bank out of Brazil. So if you don't own any crypto, this could be a way to get exposure to crypto, but in a safer manner. So what this company does is, well, actually, I'll start the context off by showing you this. 91% of the revenue comes from Brazil, and then another 6% from Mexico. So basically, this is a pure Brazil, basically pure South American crypto bank. They're actually applying for their US banking charter right now, but this is all in Brazil right now. And I'm actually bullish on that because that's where crypto's for transactional uses is really popular because we have a good currency here in the US. Over there, the currency is not so well. So they actually use crypto more for transactional purposes. So check this out. In use revenue organically, like they didn't acquire another company. This is organic. And this is in US dollars as well. 4.69 billion revenue, up 56%. And not just the revenue, but after-tax net income was up 62 to 890 million net income. If we zoom out, it hits a record every quarter. I mean, it really is impressive. And they're cheap as well because they're headquartered or because they're South American and Brazil. These companies usually just get slapped to lower multiples, and that's okay with me. A 16 forward PE, so 16 times net income for the revenue growth and net income growth that they're experiencing is very, very inexpensive in my opinion. So yeah, they're going to be making close to $1 billion in net income a quarter, according to analysts. Is there any news? Nope. They're about to report earnings on May 14th. So in 4 days, okay, watch for earnings this week. So in 4 days, they report earnings. Good luck. I'm a big fan of that one. So let's check out Fox right here. So there's Fox A and Fox B. I think this is like they sold off their entertainment business to Disney. So all those great shows like the Orville, Family Guy, they're over on, they're owned by Disney now. But this is basically just Fox News, which like, okay, so yeah, television, cable networks, they're getting, I know, a lot of donations right now from the political, but I don't want to get into politics too much, but I think that's why this stock has done so good because the president watches Fox like every day. So I have no idea. And I don't want to, but yeah, 1% dividend yield, but the multiple actually, whoa. So even though the stock has kind of gone up a bunch, this company only trades at 10 times forward net income or 10 times net income, which might make sense for a kind of television, news, cable network business. You know what I mean? So, but they really do make a good couple hundred million of after-tax net income a quarter. Pretty impressive. I guess the government can't allow Fox to go bankrupt. They need to give us propaganda. And that's why they can't let Meta go bankrupt either. Okay, I'm fine. So next up, I see Happy Mother's Day. Yeah, DTAB. Yeah, happy Sunday. Happy Mother's Day to everyone. CABA, it's a US stock. Oh, my bad here. I'm so behind. I apologize. Deborah, how's it going? We'll look at 3M. And InCar, how's it going? We'll look at Klarna. I think that's like a buy now, pay later stock. And hey, if you're enjoying the YouTube stream and TikTok, please leave a like for me. Hit the follow button if you'd like. We stream every Sunday this exact same time, and I sell nothing, literally nothing. I have no course, book, no coach, literally nothing. Just on here, give my opinion. That's not financial advice. So I'd be very careful with this stock in the top right. They're only worth $630 million. That's just really hard to trust, with your hard-earned money. I don't know if I want to trust it in a biotech with no revenue. So this is a startup. They have no revenue. Analysts aren't projecting them to have any revenue anytime soon. And they lose 42 mil a quarter. So just kind of think about this logically. You could buy this company, if you paid them, you could buy this whole asset for $620 million. Let's say you do it. You buy it for $600 million, or you're buying a company with no revenue. That's why when we click on revenue, it says no data because they've never sold anything. It's a startup. And it loses 42 mil a quarter, which is 120 mil a year, which is 15% of your market cap. So this thing's losing 15% of its market cap a year with no revenue. Biotech startup. You got to be so careful with those. They're like lotto tickets. But you're kind of just waiting for them to finally get FDA approved and get something on the market. That's the kind of catalyst you're waiting for it to 10x overnight. But those I just can't trust. Actually, there is one biotech stock I do trust. Same market cap, actually cheaper. Hold up. This is a great example. Stay here. We just looked at a stock worth $640 million. This company's worth $620 million. Same market cap, okay? Same market cap, or actually slightly cheaper. This company's worth less in terms of the valuation's cheaper. And check out this company. They make a ton of net income. If I'm going to buy a company worth $600 million, I think I'd rather buy the one that actually makes a bunch of money. Here's the operating profit. They made 59 mil. They had a slight one-time adjustment. It says after tax, they made 14 mil. They actually made like 30 mil. They just had a one-time adjustment from acquiring a company last quarter. But anyway, if we go to revenue on this, remember the other company had zero revenue and was not expecting any revenue anytime soon. This company did 128 mil of revenue and kept 59 mil before tax and like 40 mil after tax. So you tell me, and 92 million of free cash flow. So out of all the companies worth 620 million, I think I'd rather buy the one on a dip or they're both on a dip. I'd rather buy the one that's on a dip that makes a bunch of net income and free cash flow and has no net debt. So hopefully that was kind of helpful there. That's just kind of how I judge things. So 3M, please. Sure. They are the ones, actually, there's a cool marketing story. One of their employees were the ones that made Velcro. So like one of their engineers were just working on something back in the day and they invented Velcro. So anyway, they also own a bunch of different stuff. Like they own Post-it Note. They had they're acquiring Madison Safety and Flow. Huh, that's cool. Well, anyway, let's go look at the fundamentals of 3M. I know the growth has kind of been slow. So if we just go to revenue, kind of the lifeblood of the company, the sales, these year-over-year growth rates on the bottom are kind of low. 1%, last quarter's up 2%, then it was 3%, 1%, 1%. So kind of low single-digit growth, and kind of look at it over time. Besides that one-time adjustment there, the revenue is actually lower than it's been for most of its history. But let's see how the after-tax net income is. So they did $6 billion of revenue, and yeah, they are making a profit on that. They really are making a good, still 500, 700 million of net income a quarter. Looks like it is slightly down from the previous year, but yeah, I know they had a lot of lawsuit payouts. They basically sold earplugs to the military and to a bunch of people that caused the C word, but caused a lot of bad sicknesses to people. And so this lawsuit costed them in total like over $20 billion, this one earplug lawsuit, because you don't want to hurt the military. So anyway, they have over 2% dividend yield. Those lawsuit fears are mainly over at this point. So Actually, Morningstar says they're overvalued. While new CEO initiatives and product innovations show promise, massive lingering PFAS, that's what I'm talking about, the earplug, litigation risks, and sluggish organic growth in secularly declining legacy segments require extreme caution. So there's kind of the Morningstar research on that. Fox owns Tubi. Oh, that's cool. Actually, have you ever heard of Crunchyroll? Crunchyroll is owned by Sony. And I like watching One Piece. All these websites I used to like the number one pirated website in all of existence. Sony just got taken down. They were called High Anime, or I would watch One Piece on it. They just took that down. So anyway, they own Crunchyroll, and their Crunchyroll numbers should be going up. Sony talks to acquire music for $4 billion. Anyway, Sony, this is a cool stock actually. They own the Sony PlayStation. They own a bunch of music companies and imaging, like Sony Pictures, studios, like cameras. Sony's a cool stock. They're a Japanese company. Plus, you get a 0.3% dividend yield. Actually, Sony is falling because of memory prices. It's collapsing it's actually hurting Nintendo as well. Nintendo Switches, the margins for those are almost zero now, they were saying, because of the input. Yeah, look what that did to the cost. So it's like, we can now have no more margin on our Nintendo Switch 2s because of the freaking memory prices. And that's also for the iPhones right now. So they're actually having to raise prices. And then look at the news there. Here it is. Nintendo announces global Switch 2 price increases and lowers full year 2027 forecast amid rising component cost. So that's actually one of the reasons why Nintendo and Sony are falling, because of these prices. And then, the direct beneficiary is to Micron. Look at Micron, man. This stock. So be SanDisk as well. So greetings from Switzerland. Hey, Robert, good to see you, man. That's really cool. Please look at my stock as well as... Yo, Rohan, what was that stock you were talking about there? I apologize if I missed it. Oh, no, I got to it. Okay, cool. Yeah, no problem. Next up, T said BX or BTI. What's BTI? British American. Oh, actually, I don't want to cover that industry because I might get in trouble, but I will cover, the PE, PC stock, or private equity, private credit, Blackstone. It's kind of a competitor to BlackRock, but they don't own any ETFs. I kind of like BlackRock better. But let's see. Blackstone files IPO of data center REIT. Wow, Blackstone Digital Infrastructure. I actually saw that on the IPO list on Robinhood. Yeah, they're actually about to IPO a data center REIT. I actually own a data center REIT called Iron Mountain. Actually, I won't go into them. But anyway, let's go look at the fundamentals here. I know a lot of private credit, private equity business have been struggling because of the withdrawal rates. A lot of people are withdrawing their money from these. But yeah, they're just an asset manager, very diversified, private equity, real estate. Look at that. They have a credit and insurance business. How is that growing? Check out the annual trend of that. That's what you want to see for the full year 2025. It was up 28% from the full year 2024. So actually, I'm a big fan of insurance businesses, and multi-asset investing. So the valuation is cheap. You really want to value them on a forward multiple because they always have a lot of unrealized and realized adjustments to their GAAP net income. So their net income is technically higher than what it's being currently stated, hence the forward PE of an 11. So they trade at 11.5 times next year's net income. And the cool part is the dividend. You get in the top left a 4% dividend yield. Why would you get in trouble if you cover the stock? That was for this other company. It's because it's in an industry. It's in an industry I can't really talk about. If you'll see what it is in the very middle of my screen in a second here. But whenever I cover this industry, I get my TikTok. I've already actually, funny enough, I've already lost my For You page eligibility on TikTok, so the viewers are kind of just cooked from here. But anyway. The industry on this one is the drink and leaf industry. Okay, but they have great dividend yields, those industries. Hey, what's up, Clutch? Hi from the Caribbean. What is a good retirement place to hold on to? So if you're going into retirement, you'd ideally want something, I guess, a little bit higher yielding, like an SCHD, but just the S&P 500, like if you just want, the goal isn't to get rich quick. It's to slowly build and preserve your wealth. The best way to beat inflation is to own stocks, and the best way is just the S&P 500, the VOO. It historically gives you 8 to 10% of your money back every year for all of history, on average 8 to 10% a year, and it diversifies all your money up for you into all the safest companies. that I would all happily own individually. So I'd put the backbone of your portfolio in like the S&P 500. Then I'd buy and pick some of my own individual names. If you wanted a bit of a higher yield, actually have like a high yield watch list here of safe companies like the Procter & Gamble. Just put in some safe stocks like Procter & Gamble, which has a 3% yield, Coca-Cola with a 3% yield, Lowe's has a 3% yield, JP Morgan has a 2% yield, Johnson & Johnson has a 2.5% yield. I'm actually a big fan of Johnson & Johnson right now. So anyway, McDonald's a phenomenal real estate royalty company I'm a big shareholder of McDonald's actually here in my main. Look, I got a dividend only portfolio right here. It's in my Robinhood portfolio where all the stocks are paying dividends. So yeah, McDonald's is actually my second largest holding. Well, I'm down 2% on my position. You can get in lower than me. I got $5,400. That's how much I trust McDonald's. So anyway, hopefully that was kind of helpful there. So, I'm so behind, so I do apologize if I'm missing some of the chats here. Yo, what's up, Midnight? Warp ETF, bro. What is Warp? So the Van Eck Space ETF looks like it just IPO'd 2 days ago. So there's only 2 candlesticks of data, but let's see what it owns. Okay, so they just came on the market, so I can't see what the fund's holdings are, but I'm assuming it's like a Rocket Lab, a SpaceX, ASTS Space Mobile, satellite stocks, those kind of names. Hey, what's up, Plasma? Dude, Plasma for the 15 roses. You still in here, Plasma? Let me know. You want me to look at SEZL? How often are you live? Hey, it's now summer. My college classes officially ended 3 days ago. No more college finals, so I'm free for the whole summer. So I'm going to be trying streaming every day or at least every other day. So yeah, if y'all want to hit the follow button, I greatly appreciate that. Hit the like button too if you want to help me out. I sell nothing, no course books. So Rubric. Okay, let's check out this one. RBRK. This is a cybersecurity really a healthcare cybersecurity hospital stock. And I'm a big fan of cybersecurity industry specifically because out of all the stocks that are going to get hurt by AI or out of all the software categories, cybersecurity is one of those categories where I'm like, it's not going to get replaced by AI the same way Adobe might. You know what I mean? So Rubric announces Microsoft Defender integration. Okay. Wait, what does that mean? The company raises full year. Okay, well, let's just go look at their numbers. What I love about this stock is just the revenue growth. You won't believe it, but just revenue is up 46%. Actually, yeah, 46%. Last quarter grew 48, then 51, 48, 47. It grows very fast. And they didn't IPO like that long ago. They've only been public for like 2 years. The only bad part is they're still not profitable yet, but they're very much narrowing their losses. I like these green year-over-year growth rates. They're narrowing their losses. So yeah, analysts expected them to lose 99 million. They only lost 86 million. So when they're losing less net income than the analysts expect, that's a great sign. And, especially because like, I don't really want to own a company that loses a lot of money like this, but when they're narrowing losses way quicker than analysts thought, and also they have some liabilities. They do have a lot of debt, but when they have a top line growth rate of 40 to 50% every quarter, it's quite impressive. So yeah, they have free cash flow, but they have a lot of stock-based comp sending the actual net income down. So anyway, let me see if I can go to their website right here. Hello, Agentic. Well, here's their website right here. What the heck is John Cena doing? AI killed cybersecurity. Okay. Well, anyway, some sort of cybersecurity company with great revenue growth. Next up, I see Ouster. This is a LiDAR company. I actually just bought this one. I don't recommend having this as a meaningful size position. You only want this as a small position. So I only own 4 shares and I don't want any more shares really than this. So, but I still want a slight position in this company because they are very impressive. Hey, Courtney, thanks so much. I watch people on here all the time. Nobody breaks down. Hey, I really appreciate that. Yo, same here. I go to a bunch of other TikTok streams. No one ever shares their portfolio. No one's ever fully transparent, their lifetime performance. And so, yeah, if you'd like to hit the follow button, I appreciate that. I sell nothing, no course book, don't coach, just give my opinion. Nothing's financial advice, of course, but check out Ouster's organic growth. Revenue is up 48% year over year. Last quarter, it grew 106, quarter before 40. So this is organic, crazy growth they're experiencing. And they're very much narrowing their losses. Like it used to be a tough buy, losing, like 100 mil those quarters. Now they've significantly narrowed the losses. And last quarter, they even made money on a royalty payment they received. But yeah, I want to show you more about LiDAR because this is what autonomous vehicles are being powered by LiDAR. And also drones use LiDAR. I guess their website is like a video or something. But yeah, they actually, they have the first ever, this is like recent news that just came out. They have the first ever colored LiDAR. So their LiDAR's colored. And like Amazon Zoox, Google Waymo, WeRide, Lucid autonomous vehicles, they all use LiDAR. And Tesla robotaxis didn't used to use LiDAR, but now Elon Musk is coming out and saying, all right, we're now going to use a hybrid of LiDAR and our own proprietary training software. So even Tesla cybercabs are now using LiDAR. So anyway, they're actually also used in drone defense to prevent drones. So anyway, it's a LiDAR company. That's all. And I just think there's going to be a lot of tailwinds for this industry from autonomous vehicles and from drones. But still, they're not profitable. And they're still a really small market cap and there's a lot of risk. So you still want to have it as a very small position, but maybe still as a position. So yeah, I got 4 shares. And I'm at 44%. I'm shocked. I literally just bought this company too. There's my buy order right there. All right, next up here. Which brokerage stock would you buy now? Bull, Interactive Brokerage, Futu. Yeah, Futu right now. Not Weeble because Weeble's already recovered a lot. Robinhood actually too, but Robinhood's still slightly expensive. Can you explain how a company can lose 100 mil constantly and still be bullish? Hey, what company are you talking about there? It all depends. There's a specific company, like if they're narrowing losses, but most of the time, yeah, if they're losing a lot of money, I don't own any companies that really lose money. Like all the stocks I own are money printers, free cash flow generators that have so much money. They're doing dividend share buybacks and doing M&A. That's the kind of companies you want as the backbone. So APLD, and what is Mars? Is that another ETF, MARS? Also, I would love if Mars, the candy company, went public. That would be cool. They own so many chocolate brands. Okay, my thing is being slow right here. I might have to, I think I have to reset my app real quick. Or let me try that again. Yeah, hold on here. Let me reset the app. Okay, Mars, and then we'll do APLD and some of these other ones. So space and technology ETF. They're up 10% on Friday, the ETF was. And here's what they own. They own Rocket Lab, EchoStar, ASTS, Planet Lab, Global Star. So yeah, all the satellite space companies. So yeah, Mars, pure like space ETF. And I know there's a SpaceX IPO that's coming on. That's happening this year, later this year, I believe. So Roland said APLD, this is a data center stock. So all this company does is they own a bunch of graphics cards in a data center. Completes cloud business spinoff. Wait, APLD completes cloud business spinoff. What's the ticker symbol for that? Or does it show it? CHRN is the CHRN. Chronoscale. Wait, what? I don't know. Shareholders? See, yeah, there's no data here for me. Anyway, I don't know. Let's just go back to APLD. This is a cloud company. Basically, all they do is own a bunch of data centers and they rent out the graphics cards to cloud companies. So, yeah, data center hosting, HPC hosting. So they've just been beating on expectations. Analysts expected 78 mil of revenue, and they did 126 mil of revenue. But the net income, they lost 100 mil. But anyway, that's just a big, massive beat on revenue. Still losing a lot of money, and the losses are expected to worsen year over year as well. So they're not profitable or anywhere near profitability. They just have massive revenue growth. I'd still be really careful with that one. Morningstar kind of says the same thing. It actually says APLD is overvalued. Extreme negative free cash flow, a severe lack of profitability, and excessive valuation multiples warrant significant investor caution is what they're saying. So yeah, I kind of agree because they have no... Now look at these. Dang, this is the FCF. It stands for free cash flow. Negative 720 mil of free cash flow, negative 600 mil, negative 300 mil. So these are worsening year over year. So it's a bit tough in a highly competitive commodity business. If you like what they do, Nebius does the same thing. Iris Energy does the same thing. CoreWeave does the same thing. They all just own graphics cards and rent them out. Okay, so yeah, Jill, great question. TTWO, you're right. What about Take-Two GTA? So earlier he says, how can you explain how a company can lose 100 mil constantly and still be bullish? So yeah, Take-Two is a company that I dislike because of the net income losses. So you're right. If we zoom out on Take-Two, this is the company that owns Rockstar Games. So if you've heard of GTA 5, Red Dead Redemption, FIFA, I believe they own all those games. And if you look at these net income, ever since 2023, they haven't made a single dollar of net income. All they've done since 2023 is cumulative lose over, 10 billion of net income. All they've done is just lose hundreds of millions of dollars every quarter since 2023. So that's why I don't like Take-Two, but the reason the stock is doing so well is because of a future catalyst, and it's actually huge. They're about to release a game, as you probably know, GTA 6. And GTA 6 is supposed to be one of the biggest games of like all time, top 10 biggest games of all time. So whenever the second they release that game, that's instantly going to bring them in billions of revenue and hundreds of millions of future recurring revenue. So that's what's being priced into this stock right now, the future growth of GTA 6. They're in a unique spot where they can just instantly make billions of dollars as soon as they release this game. So anyway, that's kind of why that one's trading on. Those net income losses really scare me. So George said IT, what is this one? Gartner, huh? Wow, they are on a massive decline. This stock is technically the same price as they were back in 2018. So let's see what they do. So information technology, advisory to help build organizations. Here's their website right here, Gartner, built for leaders. So maybe they do like, I don't even know, like employee team building. I'm not too sure. So they do insights, that revenue's up 3%. Consulting, that's down 15%. When we combine all the businesses together, revenue year over year declined. Revenue declined 1.51%. So it looks like the growth story is gone on this company. So negative growth rate. Actually, good thing they are still making money every quarter. So luckily they are still making like 100 to 200 million of after-tax net income a quarter, but it looks like analysts aren't happy about this leverage. Dang, they have the same amount of liabilities as assets. They've always had slightly more assets than liabilities, but now it's like, actually, yeah, more liabilities than assets. So the growth story is gone. I'd be real careful with that one. I can see why the multiple is so cheap because they have a cheap valuation because the growth story is gone. So I don't know about that one. We just want to see the growth come back. I'm a newbie. How can I get advice? That's what I want. Yeah, none of this is financial advice. And the only way to learn from me is just watch my YouTube videos and watch the streams because I don't coach or sell anything, no book course. I don't ever plan to make one and sell out. So yeah, if you want to hit the follow button, I appreciate that. I stream all the time. I try and stream every day. And if you have a specific stock you want me to look at or any metric you want me to look at, let me know. I got you. Which foreign stock would you buy? Ooh, good question. Like an ADR stock. Actually, technically, Spotify is a European company. If you didn't know, I think they're one of Europe's like largest companies. Spotify, Shopify as well. Shopify is a Canadian company. AliExpress, actually, that's a Chinese company. BABA. A lot of people don't like Chinese companies, because they always trade at low multiples. But Alibaba specifically is growing their cloud business. They own AliExpress, which is an e-commerce company, but they also have this cloud business. This is the largest China cloud. They're up 42% year over year. The growth rate over there is booming on Alibaba, and you get a dividend. But anyway, those are some of the ones. But Shopify, should we go over Shopify? I think that's a big Cathie Wood stock. Actually, if we go to the Cathie Wood portfolio right here, she got Tesla, AMD, and then Shopify. Let's do Shopify really quickly. It's another big e-commerce company. What impresses me, though, is the revenue growth, where literally every quarter, like this company's revenue hits a record. So that's the growth you want to see. If you're just going to diamond hand, buy, and never sell a stock, you just want the revenue to only grow. So yeah, revenue grew 35% year over year. That's the highest growth rate on the screen, actually, 35%. And the best part is they have no debt. That takes so much risk off the table when a company has no debt and $8 billion of cash. And they just print money every quarter as well. So they're making it look, they're the most profitable they've ever been. They used to kind of lose money. Now they're back to making good, consistent profits. I used to have a Shopify store and I paid for their highest tier subscription. And even if you pay for their highest tier subscription, Shopify takes 0.25% of every single sale that you get. So they're collecting a 0.25% royalty basically on every single product ever sold on their platform, even with their subscription. So anyway, Shopify, good company. Just, Super expensive though, like really expensive. Oh, hey, Kiyoti, are you still in here? We'll look at STZ. If you're still in here, I apologize. I'm so behind on the chat. I mean, I'm reading both the YouTube and TikTok. So North Country says, what is advice you would give to someone just getting into the stock market? Yeah, so I would, don't do anything risky. Don't buy micro caps, don't buy crypto really. Just buy high quality companies that love and use. Like if you like Amazon and pay for Amazon Prime, buy Amazon stock. They also own they own a grocery store called Whole Foods, they own Twitch. They have the AWS cloud. If you like Google and YouTube, buy Google stock. I love all of Google's products like Gmail, from YouTube to Google Cloud to Waymo to Quantum Chips. McDonald's, a real estate royalty company. Meta, if you like Instagram and Facebook, buy them. If you are a fan of nuclear, actually my actual utility bill is through Constellation Energy, our natural gas utility bill. But Constellation Energy is not just a utility company that does natural gas. They're the #1 nuclear company. They own 33% of all the U.S.'s nuclear reactors. United Rentals. Anyway, just buy great, high-quality S&P 500 companies, and of course, buy the S&P 500. You can't go wrong. No financial advisor that you have would be opposed to saying, hey, I'm buying the S&P 500. It's a collection of 500 of the best U.S. companies. It diversifies you into all the best stocks that I'd happily own. So buy the backbone of your portfolio in the S&P and then pick some individual names like Nvidia, Apple. If you like the whole Apple ecosystem, a lot of people are locked in the Apple ecosystem with the AirPods and the MacBook and the phone. Buy Apple with the great brand. So next up, DJ said, what do you think about GGB? Let's find that one. So Gerdau. So I've not heard of this stock before, but they've done pretty good. I mean, no, I didn't realize I'm on a weekly here. They've done good the past year, but they're the same prices they were back in 2021. But yeah, they have done good this past year. I'm assuming it's some oil and gas type stock. Steel industry. No, so this is a steel company. Wow, okay. So yeah, specialty bar quality. So yeah, they sell steel products, rebar. So there's actually another steel company I like. Oh, it's a Brazil company. Okay, they're not headquartered in the US. So we're going to convert the currency from Brazil currency to US dollars. I don't know, is that like pesos or something? But yeah, they're headquartered in Brazil. We've converted the currency to US dollars. And let's see what they do. So actually, besides the one quarter last quarter, they make good money every quarter. I mean, usually a couple $100 million in net income. Looks like last quarter there was maybe a slight one-time adjustment, but yeah, usually they're making well over 100 to 200 mil of like US net income a quarter. What's the net margin on that? So yeah, so the steel industry, you get around a 6 to 8% net margin. My favorite steel play of all time is Steel Dynamics. And check out how good this one does. And they're at an all-time high right now, and they're at an all-time high for a reason. And even at all-time high, I don't think they're ridiculously expensive. Even at all-time highs, a 14 forward PE, which could stretch up higher. But they make a lot more consistent net income. Like last quarter, they didn't lose net income. They made net income. So yeah, they're making a good couple $100 million net income a quarter. Actually, their net income trends look very similar, where it was crazy high in 2022 with the supply chain issues. So if there's ever supply chain commodity issues again, steel's going to the moon. All right, next up, let's see. What do you think about XRP? I wish I could give you thoughts on crypto. I mean, the cool thing about crypto is that there is no earnings reports. So it's kind of like a catalyst-free asset. They can't report earnings and miss on net income and miss on their net margins and fall because of that. So that's kind of the cool thing. What are related products? Oh, I guess there's like ETFs. Oh, wow, there's a bunch of them. The Franklin XRP ETF. I didn't know there's XRP ETFs. I thought it was only Bitcoin and Ethereum. Well, cool. Looks like there's a bunch of them now. All right, next up. So yeah, I apologize. I heard XRP though, like out of all the cryptos, I've done no research, but I heard like XRP actually has a utilitarian purpose, like a utility to it. It's not just some, I don't know. I don't know what it does, but there you go. Hey, what's up? Vicious, how's it going? He says, how do you feel about Intel, Dell, SanDisk? Thanks. Yeah, a lot of them are really expensive, but like SanDisk, for example, honestly, here's the crazy part. It's going to sound absolutely crazy, but I feel SanDisk and Micron are just going to continue to climb a little bit higher. Here's my thesis behind this. It's all valuation-wise. When we look at a forward multiple, if we judge SanDisk on next year's net income, They only trade at 9 times next year's net income. And I feel like that number could stretch up higher to like a 12 or a 13 and send the stock up literally another 30% before it maxes out. So yeah, look at the net income projections from the analyst. On the very left, it's 112. So the net income is going to go from 112 mil to on the right to $6 billion. This is a pivotal year for SanDisk, and no wonder the stock has had such a massive rally. Actually, they did in less than a year what took Nvidia 5 years. I was doing the math earlier. They went up more than Nvidia did in a year than Nvidia did in the past 5 years. Anywho, it's basically because of this sudden change of net income so quickly, where they're going to be doing, 30 billion of net income a year. And if they do 30 bill a year and the whole company's worth 230 billion, yeah, wow, that's only 9 times forward net income. So basically, the market's pricing in the future growth to a more normal multiple. So, but that being said, if you're a shareholder of that stock, that means don't trim, or definitely don't fully sell out. Maybe trim a little bit, but don't fully sell out. But I also don't know if I'd exactly be buying it at all-time highs. Here's Dell as well. This is a data center infrastructure company. They help install your racks and your servers for you. And the valuation is even at all-time highs. This is another one. This is what I like to do. Even though the company's at an all-time high in stock price, I assume it's going higher because of the valuation. It can easily go higher. The forward PE is a 23. And for the growth that they're experiencing, specifically on their infrastructure group, I think it's justified. Or it's actually even undervalued. The most recent quarter, the infrastructure group grew 73% year over year. After grew 22. So the growth is finally back. And they crushed expectations. Analysts expected 31. They did 33.3. They expected 2 bill in net income. They did 2.25 bill. So that year over year is a 47% increase. That's actually a record net income. Yeah, look, besides that one-time adjustment quarter, which wasn't real, I'll prove it by the operating profit. Yeah, operating profit proves it. This is the most profitable quarter they've ever had in their history. So this is their before tax number. Before tax was 3.15. After tax was 2.25. So they really did keep after tax 2.25 billion. And what are they doing with all that? The best way to return money to the shareholder is share buybacks. They're going crazy on buying back their own shares. At the top, they're spending $1 to 2 billion in net income a quarter buying back their own shares. And whenever they buy back their own shares, it gives you more ownership in the company. It makes the dividend cost less. Look, the dividend literally went from $3.96 to $3.40. How did the cost of the dividend go down? They didn't cut their dividend. They just bought back so many of their own shares. When you buy back your own shares, you don't pay dividends to those. So it gives you more ownership in the company. It makes the EPS grow faster and basically forces the stock to go up. So they've bought back 7% of all the shares in the past year, plus the 2% dividend yield. It's actually ridiculous. All right. What's up, my music? What are your thoughts on AAOI? Looks like a real winner. Let's check it out. AAOI. Applied Optoelectronics. So they've had a gangbuster rally these past couple weeks here, kind of like with a bunch of AI names. I'm assuming it's some AI infrastructure company. So let's see, reported revenue of 150 million, up 51% year over year, and raises the full year guidance above 1.1 billion. And the whole company is worth 12 billion. So they're trading at 12 times sales. Multiple analysts raised price targets on Applied to 220 following the Q1 results. So, okay. Is there any specific? Okay, the company completed first volume shipment of 800. Okay, actually, let me just go look at the numbers first of what the analysts expected. So, analysts expected this quarter, 100. Well, they actually slightly missed on expectations, but the future growth is super good. Yeah, if they're going to do $1 billion of revenue for the full year, that has to be 250 mil a quarter. And yeah, check out 2 quarters from now, the analyst projection, they're going to do 260 million of revenue, which is an insane rally from today. Yeah, already the revenue's up 51%. This growth is not going to stop anytime soon. The revenue is supposed to hit $1 billion a year or 250 mil a quarter. And that's for this year. So wow, actually, so then the back half of this year, they're going to have a ton of money. And they're going to be making a ton more money. They are still slightly losing a bit in net income, but let's see the projections. Wow, so in 2 quarters, so yeah, if I was a shareholder, I would wait for the next 6 months. They're going to get net income positive in 2 quarters, and the revenue is going to more than double. So yeah, it looks like they're a data center and cable television company. Data center, I wonder, the data center revenue is up 154%. I wonder if it's just like another like they rent out the capacity of GPUs, or maybe they actually, oh, they're trying to get my cookies. Nope, deny. So yeah, I guess they're selling actual components, yeah, optical components, optical transceivers. So kind of cool. And it's definitely stuff that, data centers are using right now, and anything data center component wise are going to the moon. So, hey, Nathan, what brokerage do you use and which ones are for foreign markets? Hey, I actually, all the brokerages I'm using are in the description of this YouTube stream. They're on my link tree as well. But yeah, I'm on Moomoo, Robinhood, and Weeble. I don't know I don't know what country you're in, so I don't know if you're allowed to get this brokerages. But yeah, if you'd like to get this app I'm on, it's in my first link in the description. And if you're on TikTok, this app I'm on is the first link in my profile. Very first link there. Dell, I want to see the fundamentals behind it. Yeah, Nicolo, I'd be surprised too. Like most people, when they think of Dell, they're like, oh, you're like those old PCs and those old laptops. That's the thing. Their hardware business sucks. Low margin hardware business, but it's this infrastructure solutions that they're helping out data centers with that's booming. Kind of cool. DRAM ETF, yeah, I saw more people talking about this one. This is your memory ETF. So if you don't know, like if you want exposure to this whole memory shortage, you're like, oh, I don't know which one to buy. Do I buy Micron or SanDisk or Western Digital or whatever? With this or Samsung, this ETF just diversifies you into all of the best memory shortage stocks like SK, Samsung, then Micron, then SanDisk, then Seagate. So pretty cool because all of them are at a crazy all-time high right now, especially Micron and SanDisk. That's crazy. So, hey, shout out to member Looney. He said Home Depot stock. This is a great dividend growth company. A lot of HOAs like mandate you update your landscape. So, they all, and every time there's a storm that happens, people always got to get new gardening mulch and stuff like that. So, Home Depot's a cool one. Right now, they're just struggling because of all the real estate is because rates have been up higher than expected. So Home Depot does kind of trade with interest rates, but you get a great yield and it is safe. They have a 2.9% dividend. So basically, if you buy Home Depot stock right now, you get 3% of your money back just in a qualified dividend every year. And the valuation isn't expensive. This is like cheaper than the S&P 500, 21 forward PE. So they trade at 22 times net income. I mean, pretty cheap. Here's the net income they're making every quarter. It's like 3 to 4 billion of after-tax net income. So let's see how much the dividend costs. So they're making 3 to 4 bill a quarter. The dividend costs 2.29 billion. So as long as they're making over 2.29 billion a quarter, they can easily afford the dividend. And notice every quarter, like this quarter, they made nearly 5 billion. They can easily afford the dividend. That's why I like deep diving into the cash flow statement to see how much the dividend cost exactly, because there's a lot of companies I see people recommend like Home Depot, or not, we just looked at Home Depot, like UPS that has a questionable dividend yield that's over 100%. And Starbucks as well. Actually, the dividend payout ratio is exactly 100% on UPS. Like there's some companies, basically, here's how you can tell if a company has a safe dividend. You go to the cash flow statement, and then you scroll down to the cost of the dividend. So every quarter, UPS pays $1.35 billion a quarter in dividends. So they have to make $1.35 billion. And if we go to their net income, only one quarter out of the 4 quarters could afford the dividend. So like this quarter, they only made 184 mil. So anyway, let's keep going here. I always look for companies that make so much net income, it covers the cost of the dividend. And then they have a bunch of room to do share buybacks. Actually, a great example of that is Apple. Holy moly. So look at this. Here's Apple's net income. 29 billion in net income this quarter. So Apple made after tax 29 billion. Their dividend cost $3.8 billion. They could easily afford to double or triple their dividend right now. They just choose not to and instead do share buybacks. Check out the top here. Apple spends $20 billion a quarter solely buying back their own shares every quarter. Yeah, like you heard that correctly. It's the number one buyback program of any company on earth. Apple spends $20 billion of their after-tax net income solely buying back their own stock every quarter. And they pay $4 billion out in dividends. But they're the most shareholder-friendly company. That's one reason why Apple never goes down, because they just buy back so much of their own stock, gives you crazy more ownership in the business, makes the dividend cost less, makes the EPS grow. So pretty crazy. So Bull stock, yeah, this is a brokerage right here, Bull. I do have a brokerage with Weeble. So Bull is literally this app right here, publicly traded. At the top of my screen, you see how this app is called Weeble. Well, here is Weeble stock in the top left, publicly traded, ticker symbol BOLL. And I'm a big fan of their platform. And one of the reasons I'm extra bullish on their stock is because this brokerage just added in prediction markets, which I never recommend doing. It's total speculation, but this makes brokerages a lot of money. And they also just added in right after they IPO'd as well, crypto. So this brokerage now lets you do prediction markets and crypto, which you weren't able to do before their IPO. They just added in these features. And that's why I actually think they're going to grow faster than analysts project because of these prediction markets. Robinhood makes so much money from prediction markets recently. So revenue grew 49% year over year. I think it's going to grow even faster. So that's Weeble stock. That's my thesis behind it. They're still kind of expensive, no PE. There is a forward PE of a 52, but that's a really expensive forward PE. So out of all the brokerage stocks, I do own them, by the way. I do own Weeble. I'm still down 7%. I would rather buy Robinhood and Futu first, and then I'd buy Weeble stock. So yeah. By the way, I own Robinhood, I own Weeble, I own Futu, I own SoFi. I just love the whole fintech industry. Coinbase is another decent one. What about oil ETFs? I don't know any. Is it XLK? Is that an oil one? No. I don't know. Is it XLE? Yeah, here's the XLE. This is just an oil ETF that just owns all of the top oil names by their market cap. So the largest holding is Exxon because they're the largest oil company by market cap. They're worth like 400 bill. Then it's Chevron, then ConocoPhillips, then Schlumberger, then Williams, then Marathon, EOG. Pretty cool. So yeah, if you don't know which oil stock to buy, just buy the whole ETF. What are some of your newest positions? Yeah, so here are actually all of my newest positions exactly in order. So it's been General Mills, then Ouster, then Uber, then Microsoft, then applovin, then abbvie. And these are all in the past month. Like you wouldn't think so, but yeah, I literally bought Microsoft pretty much exactly a month ago. I haven't really been buying anything the past 2 weeks because the market's been so strong. But another recent purchase is Moog, or is a newest position. I just bought Moog for the first time ever on that day back there. But yeah, that's it basically. Oh, and CareTrust REIT. Should we sell Micron or hold on to it? Yo, I actually would not fully sell out of Micron. I would maybe trim a slight bit, but definitely don't fully sell out of Micron because the forward PE is an 8. This forward PE of an 8 can easily go to like a 12 and send it higher. So Sergio said AMD stock. This is a crazy performer because of the CPU shortage happening and them bringing back the manufacturing back to America. So yeah, they were up 11% on Friday. Let's see, is there any specific news? AMD doubles server CPU market forecast to over 120 billion. Wow. AMD announced a strategic partnership with Meta for 6 gigawatts of GPU deployments. Dang. That's pretty crazy. So let's go look at their numbers of what they reported. So analysts expected 9.9. They did 10.25. They expected 1.24 billion net income. They did 1.38. So they beat on every metric. They beat on EBITDA, EPS, net income, revenue. And the data center growth, I believe, is the growthiest. Let's check that out. Yeah, look at the growth rate at the top. It grew 57% after it grew 57%. After it grew 80%. So they're on a streak of growth on their data center business. So that must be why they're booming. So yeah, revenue's up 37 and they have no net debt. They actually have a fortress balance sheet. So no net debt on AMD. The net income is like the highest it's ever been. And yeah, if we zoom out, that's a beautiful trend. So record net income, record profitability, just expensive. That's the tough part. They are super expensive at a 69 forward PE, but notice how the PE is getting cut in half. So they currently traded 149 PE, but it's getting cut in half to a 69 on a forward PE. So they're basically doubling their EPS from this year to next year. Yeah, look at the projection. It's going from 75 cents of EPS to $1.28. So the next couple quarters are going to experience some crazy net income growth from the CPU shortage. They're raising prices, higher margins. Pretty cool. It's like the picks and shovels play. So George says SWKS. What's Skyworks Solutions? Hey, Kenya said, what's going on with Lululemon? Let's check them out. Yeah, the consumer clothing apparel stocks have been struggling. So here's Skyworks Solutions. I feel like I've heard of this company. I forget what they do though. They are a semiconductor company. Okay. They design, develop, manufacture, and market proprietary semiconductor products. The revenue has not grown though. The revenue is actually, negative 1% year over year after it fell 9%, after it fell 13. So yeah, check, that's not exactly great. That might be why the stock is struggling, because the actual fundamentals, the revenue is struggling. It's like lower than it was in the year 2020. So revenue's flat. And actually, they are profitable, so that's great news. But look at the trend of the net income. They used to make 300 to 400 mil in net income a quarter. Now they're making, like, margins are being squeezed here. Maybe they're in like just a competitive industry. Maybe they're just getting. Oh wow, they have a 4.3% dividend, so it's kind of like a dividend play. You get a 4.3% dividend yield here. I don't know. I just be careful because of the revenue growth is negative, net income is negative growth. So yeah, I'd be careful with this one. Or what's the valuation? So they traded and they're not exactly cheap either. Even on the dip, they're not even like cheap at a 33 forward PE. So the net income is actually going to decline. Yeah, dang it. So the net income is going to go from 140 to 90 mil. So that's a decline. Dang. So they're actually expensive. I actually would not buy them on the dip, unfortunately. So Lululemon, actually, it's not just a Lululemon problem. Nike, Under Armour, all these stocks are absolutely tanking right now. And the valuations are cheap, a 9 times net income. Oh, here's cool data. We get their number of stores. They got 796 stores. And okay, so yeah, it's a margin decline issue. So check this out. The revenue grew 0.8%, which already isn't that great growth. That doesn't beat inflation. So revenue didn't grow really. Revenue's up 0.8. But on the 0.8 of revenue, the net income declined by 21%. So what does that mean in English? Margin declines. So their gross margin fell by 9% and the net margin fell by 22%. Now that is starting to explain why the stock has had such a rough time. Growth is slowing down, margins are declining. Yeah, so negative net income projections. That's why the forward PE is actually higher than the current PE, because the net income is supposed to decline over the next year. So actually, Lululemon, according to Morningstar, is significantly undervalued. The hiring of a highly experienced new CEO, combined with the robust international exposure opportunities and premium brand pricing power, will drive long-term value growth. I will say Lululemon does have the pricing power. They do have some very high-quality products. I know that they do have a lot of new competition from Amazon's brand. Amazon clothing actually has a 15% clothing market share now. So Amazon's almost like a way you can also get exposure to clothing. But yeah, that's the company there. And yeah, so it's not just Lululemon on a big dip. Nike's almost even worse. And I used to own Nike. Check that out. There's my sell order. I sold all my shares of Nike at $80, and dang, it's $44 today. They also are having a massive decline in revenue, margin. So yeah, look at Nike also. Revenue's barely up at 0.09. So revenue's up 0.09, but net income is down by 34, which means net margins are down by 35%. Oh, y'all don't want to see Under Armour. UAA. Look at this chart right here. RIP. Under Armour is the same price that it was in the year 2010. So you bought Under Armour in 2010. It's the same price that it is today. Rip. Do you day trade? Yo, Jojo, I do not day trade. I actually do the most boring thing. I just buy and hold great companies, like great growth stocks. And I don't sell them. I don't trim them. Well, just in that portfolio. I have a bunch of other portfolios as well. But yeah, I don't do any options. I don't do any crypto. I just buy growth stocks and dividend stocks. Yeah, my phone is about to die. Luckily, I have to end this. I have to go in 4 minutes, unfortunately. So hey, if y'all are enjoying, please leave a like. And if you hit the subscribe button, I stream every Sunday this exact same time. And I'm going to try and stream every day this week. I'm finally off of college work. So finally, finals ended 2 days ago. So I'm so happy. So we'll see 1 or 2 more stocks here. Then I unfortunately have to go. Yo, Jeff Mack. Shout out the member, Jeff Mack. Thanks for being a YouTube member. He says IONQ. This is a quantum computing play. There's been a lot of momentum around quantum. Uh-oh, my Wi-Fi just tanked on me. But anyway, here's IONQ right here. They've had a massive little gap up on I don't know, what was it? Was there any specific news that made them go up so much? So Skywater Technology approved acquisition by IONQ. Also, IONQ is doing an acquisition There's a lot of positive news. IONQ secures a $39 million space development agency contract. That's pretty cool. So they just rose their guidance as well. So basically, you're looking off the future growth expectations, especially with the acquisitions that they're doing. I bet the future growth projections are going to get revised even higher because they've been beating on revenue. You just got to be careful because they are still losing money. Like they lost 270 mil, 230 mil, 170 mil. So they're losing a lot of money, like the most money they've ever lost. So very unprofitable, but they have the growth. Like check that out. Incredible revenue growth. And they're not done. I mean, the revenue's not going to stop. So yeah, Amazon used to own this one, but then Amazon sold out of their position. Morningstar says they're undervalued. Exceptional trailing 3-year revenue growth reflects strong market expansion potential. The company's very high uncertainty rating and lack of economic moat demand careful monitoring. That's a great way to put it. Yeah. Let's go to their website real quickly. And shout out to I don't know how to pronounce that, but Yaroi. Yo, thank you so much for becoming a YouTube member. When you're a YouTube member, you get access to my private Discord. And again, if you cancel your YouTube membership, you get permanent access to the Discord. And also, if you just wanted to join the Discord, it only costs $1. I made it the cheapest amount possible because I don't want any bots or anything in there. So yeah, if you want to join my Discord, you can become a YouTube member and you can cancel after and you can join. It's in the community post, or you can just donate $1 and the link tree in the description of it. No way, dude. Markers, dude. Y'all are making my Sunday. Thank you. Happy Mother's Day, everyone. I hope everyone's having a great Sunday, dude. Marks for the YouTube member as well. Man, I appreciate that. And speaking of IONQ, last thing, they have a backlog. The third line here, they have a backlog and it rose 544% year over year to $470 million. So they have a $470 million backlog IONQ has. Pretty cool. So hey, tell your mother you love her. Yeah, hey, shout out Henry. Good to see you, Henry. And Easy Doodles. What's your thoughts on Micron? Yeah, I think Micron's going to continue to climb another 20, 30% higher simply because of valuation. Do you think the market will keep going up or are we in a bubble? Honestly, a lot of stocks are at pretty fair valuations. Yeah, hey, V-Money, this app, or it's a brokerage where you buy stocks on. It's a brokerage called Moomoo. Also have it linked in the description, the very first link if you'd like to get this app. It's where you buy stocks on. So yeah, very last company here, Nvidia, like our largest company in the S&P 500, they're only at a 25 forward PE. So that's why I think Nvidia is going to continue to climb higher. Like a lot of the top holdings, the top weightings in the S&P 500 are still cheap. Microsoft trading at only a 22 forward PE. Meta trading at a 19 forward PE. Now there are a lot of other stocks that are ridiculously overvalued, but there are a lot of stocks out there that aren't overvalued. Let me hide my screen really quick. Let me just double check that. Oh, I can keep streaming. Okay. The plans I just had were canceled. Yo, let's keep streaming then. Get my charger. Well, I had a Bible meeting, but I guess it got canceled. Okay. I'm plugging back in my phone. So we're just gonna keep on streaming. Hey, thanks for everyone that's here. I normally end it at 2 every time on Sunday, but let's just keep analyzing. All right, so next up here, yeah, I can just stream forever at this point. So Zim, so the next door guy, he said Zim. I won't really cover this stock because they're being acquired. So basically this stock is going to cease to exist in about a month or so. A private company is taking them, or a company is taking them private. And that's actually genius, by the way. They have a dividend, or this company has a rule. Dividend investors love this stock because whenever they make money, they have to pay out. That's your own rule. They pay out 50% of whatever net income they make. So historically, look in the year 2022, they paid out $27 in dividends that year. So, and look at the share price. One share cost $26. You got a 100% return just in dividends that year. Imagine, and that costed them, let's actually go see, it costed them $1 billion. It's their exact same market cap, or we can just do the math. It costed them $3.2 billion. They paid out $3.2 billion in dividends this year. Imagine what their market cap would be if they kept that $3.2 billion instead of paying it out. So anyway, the company that's taking this stock private is genius because they can just keep all the dividends for themselves. It's actually really smart. Yeah, hey, Thick and Markers, if you got any stocks you want to look at, let me know. Thanks again for becoming a member. Y'all are the best for real. And hey, Plasma, thanks again. So next up, we got, XXI. Let's check out XXI. So 21 capital in the trade desk. So this is a $3 billion company. I've never heard of this stock before. So there is no rev. That's weird. So I guess because they just IPO'd, I wish I could give you thoughts on this company, but look, I click on the financial data here. There just is no data loading in here. So they have 3 employees. This is a blank check company. 21 Capital is focused on Bitcoin-related businesses. It offers shareholders a differentiated opportunity to gain exposure to Bitcoin through the equity markets. Okay, so I don't know about this company. Here's their website right here. Okay, can I view anything? Okay, yeah, about it operates its treasury are aligned with 21 million. See, I don't know what exactly they do. Some sort of crypto thing. I apologize. That probably wasn't too helpful there, but there's no fundamentals I can really judge. So let's check out TTD right here. Is a Discord a one-time thing? Yeah, it is. It's a $1. I sell literally nothing. The only thing I technically sell is a Discord, and I made it $1, the least amount of money possible, just because I like it as a small community, and there will never be any scammers or anything in there. So here's the Trade Desk stock. It's an advertising company, and they're seeing increased competition from Amazon. Amazon now, like I remember when they released it, Amazon does exactly what Trade Desk does now. Let's see. Trade Desk partners with DramaBox as first demand-side platform. They missed analyst guidance. Okay, so they missed expectations and issued weak Q2 guidance. So one thing that used to be an example here is a Netflix. Netflix, when they first created their ad tier subscription, they used the Trade Desk to find advertisers. Now Netflix actually canceled the Trade Desk and went over to Amazon. And whenever that news happened, the stock dropped like a rock. But anyway, I actually am Dang, even Morningstar's bearish. I thought they'd be bullish, but not. Morningstar says they're overvalued. Intensifying competition from Amazon's demand-side platform and a structural disadvantage in proprietary consumer data require caution. Dang, they're extra bearish. I'm not that bearish. The valuation's actually cheap. They traded a 21 forward PE, which means they trade at 21 times next year's net income. That seems pretty fair to me. But let's see if we can figure out what they reported. So they beat on revenue. They missed on net income just by a hair. They missed by a hair on net income, which is no big deal. But that did mean margin decline. So yeah, revenue was up 11, net income fell 20. So the net margin fell by 30. But anyway, they have a 21 forward PE. I think all the bad news, most of the bad news has got to be priced in at this point. It's nothing new to investors, this Amazon competition. I've been talking about the Amazon competition for over a year. I remember the day this stock dropped on this earnings report. So we've been covering Trade Desk for a long time. It's just the Amazon part that scares me. That might be what's hurting the multiple. But they're finally, whenever we were analyzing the stock in the past, they always had a 31 forward PE. Now the forward PE is a 21, where it's actually kind of pretty good to buy. Okay, Matt just said my favorite Chinese stock of all time, Tencent. This, I promise you, if you like video games, you'll love this stock. If you've heard of Riot Games, which is League of Legends and Valorant, they own Riot Games, which is League of Legends and Valorant. They own Supercell. So if you heard of Clash of Clans, Clash Royale, Payday, Boom Beach, they own all those apps. They own 49% of Epic Games, and Epic Games owns Fortnite. So they own half of Fortnite. They own PUBG and PUBG Mobile. I could keep on going. This company is, if this was a US company, they would be in the Mag 7. They'd replace Tesla and trade at a much higher multiple. But yeah, they traded a 15 forward PE. So they only trade at 15 times net income. And here's the net income projections. And again, we've converted the currency. This is in US dollars. And check this out, analysts projected 7.79 to 8.3. They just beat on expectations like crazy every quarter. And they just print a crazy amount of net income, like $9 billion of after-tax net income a quarter. So anyway, and they have a bunch of stakes in a bunch of different companies. Tencent owns 10% of Reddit, 10% of Pinterest, 10% of Snapchat, 10% of Yelp. So many different and the list goes on, like a million more stocks. This is an actual behemoth ETF and my favorite Chinese stock by far. So what's up, Chris? He says VRSN, and then we'll look at, I'm so behind here. Hey, what's up, Christian? We'll look at Supermicro and Tint. What's up, DJ? Look at TINT after this. So VeriSign stock, they've done really good. They're pretty close to an all-time high. What do they do exactly? So this is a software infrastructure. They're in the Warren Buffett portfolio. So Warren Buffett does own this stock. Morningstar says they're fairly valued, while its exclusive regulatory control over .com and .net domains. Whoa, I got to learn more about that. It's exclusive regulatory control over .com and .net domains and consistent price hikes provide highly predictable and durable cash flows. The current valuation already bakes in these future growth expectations, though. Yeah, I can kind of see that at a 30 forward PE, it is starting to get on the edge of like a really expensive valuation, a 30 forward PE. But they still print net income. They're still making over 200 million of after-tax net income a quarter. But that is a kind of not so great balance sheet. They have like twice as many liabilities as they have assets. But the stock's done great. I would be curious to learn more about that .com and .net domain control that Morningstar's talking about here. Exclusive regulatory control and the price hikes around it. That's kind of cool. Maybe someone can tell me more about that if they know. So next up, let's do, Sezzle. Let's do Sezzle really quickly. I have not Plasma. So have you looked at Sezzle post earnings? I have not. Let's check it out. So this is one of my favorite fintech stocks that are cheap. And hey, what's up, Eric and Chris and Faker? Good to see y'all. So Sezzle, they're cheap. Just a PE ratio. They trade at 23 PE, but the forward PE is a 16. That's why I think this stock, even though they're kind of up at a new like multi-month high, I think you're going to continue to climb higher because the valuation's a 16. And here's what justifies the 16 PE. I think it should be much higher, but they have the growth of a great company. The revenue's up 29%. Last quarter grew 32, 66, 76, 123. So record revenue, it's 135 million this quarter. It's never even been higher. And on this 135 mil of revenue, they kept an after-tax net income 51 mil. And that's real. Before tax, it was 66. After tax was 51. I am incredibly impressed with the profits they make. Yeah, record profitability quarter. And again, it's real, not some one-time adjustment. Real record profitability after paying 11 mil of taxes. Same with free cash flow. So 30% net margins they're running at. Incredible. So yeah, Sezzle, pretty cool. Dave's another one I really like. They also fell on earnings. So what was it? TINT. That's what it was. TINT. What is this one, DJ? ProShares Smart Materials ETF. I wonder what they own. Is it like a Dow Chemical, a Solstice, or Corning, Applied Materials, Hexcel. I've not heard of that company before. They're at an all-time high. Merck. That's surprising. They got Merck in there. I haven't heard of some of these. CBT, Cabot. Huh. Or they must be, specialty or smart materials companies. The 0.58% expense ratio fee. So I guess the smart materials sector, if you like that sector, you could buy that company. So what is TD? The Toronto Dominion Bank. Oh, these Canadian banks have been crushing it. There's another, I think it's called like the Royal Canadian Bank. I don't know. All these, most of the Canadian banks are at the moon. They're to the moon right now. So anyway, check this out. You get a good dividend as well. If you buy TD stock, even at all-time highs, even after this crazy rally that they've had, you buy it right now, you still get 3% of your money back in a qualified dividend every year. So let's actually convert the currency from Canadian to US dollars just to get a slight better idea here. So yeah, 33% of the revenue is Canadian personal commercial bank. And then they're also in US banking. 24% of the revenue is US bank. And I love when banks do wealth management and insurance. Okay, wealth management and insurance. I like the combo. They collect high margin management fees, and they collect the float revenue from the insurance business. So anywho, this is their after-tax US dollar conversion net income. They're making over 2 to 3 billion of after-tax net income a quarter. So congrats if you own this company. You definitely got to be up on your position, and plus the dividends. That's really cool. Is it RQ maybe? Is the Royal Bank of Canada? Oh, the RY stock. Yeah, look at RY. This is a different Canadian bank. They are also crushing it at a crazy all-time high right now. And this one has a 2.5% dividend, slightly lower, but still a good yield. So Sergi, what's up, Sergi Mers? Good to see you. And Dylan said GDC. What is GDC? Then we'll look at what's up, D and Illuminated. Hey, Nathan, how do I find you on Discord? Oh, hey, it's actually in the link in the YouTube description, or it's actually in the link tree. I should make it a specific link in the description, but you have to find my link tree in the description, and then it's like the 5th link in my link tree. You'll see it the Anyway, I'm actually not going to cover this stock. Look in the top right. This is actually scary. This whole company is worth 9.7 million. This is a micro cap if I've ever seen one. The whole company is worth $9 million. I'm sure someone in here could maybe buy the whole company, but look at this. Like, this is why they're at an all-time low. The whole company's worth 9 million and they lost 164 million this quarter and 190 million the quarter before. And they have no revenue. So unfortunately, there's nothing for me to really cover there. Dude, my charger is like broken. Or it's actually my computer. It's plugged into my computer and it's like broken. All right. Sergi said ABT. That's Abbott. Yeah. So I think this is like a medical devices company. Unfortunately, oh no, this is a medical testing company. So this is how a bunch of prescription companies can go and test the effectiveness of their vaccines and prescriptions. So unfortunately, the stock is the same price that it was back in 2019. So the stock has been flat for a really long time, but you get a good dividend because whenever the stock price goes down, the dividend yield goes up. So you get a 2.85% dividend yield. The forward PE is a 19, so it's actually pretty fairly valued. The sad part is, even after this big dip, I would say current value is fair value. This is like fair value for the stock. So yeah, 59% of the revenue is medical devices. Then they have their diagnostic products, nutritional products, and the growth has kind of just slowed down recently. Medical devices actually really good growth, double digit. That's up 13. But okay, I'm just not using this charger. Diagnostic products, though, historically used to always run at a decline, and now it actually grew positive this quarter. That's great news, actually, up 6.13% right now. Or year over year. And then you also have nutritional products, which is down 6% year over year. Oh, well. So when we combine all the businesses together, revenue is up 7.78, which this missed expectations. So here's what the orange lines, what the analysts project. They expected 1.51 billion net income. They only did 1.07. So they did miss by 400 mil. They've actually missed on net income for the past 3 quarters in a row. So that's why I suspect, for the past 3 quarters in a row, gap down on earnings. And then, yeah, so it's fairly valued at current prices. They still print net income. Don't get me wrong. They still print net income. What do you think of REA stock? REA, what is that one? Rare Earth Americas. Oh, did they change their ticker symbol? Oh, this is a new IPO. So this stock has only been public for 3 days. So yeah, basically the US is trying to get more rare earth mineral independent. And it looks like maybe this one, they got 21 employees. It operates, the Brazil mining operation is comprised of Alpha Minerals. So basically, I think they just own a bunch of rare earth mineral mines. And it looks like maybe one of them is, and it's called Americas. So it's in South America, some of these. Yeah, here it is. They got one in, I don't know, what's that, like Georgia or something, or Florida, but then they got some in South America. Interesting there. I wonder what mineral specific they're trying to mine. Okay, yeah, they do have one in America, but yeah, they have no revenue right now. So we can go to revenue and analyst projections. There is none because I think they're still a startup. So I wish I could give you more thoughts on them. There is just no like numbers I can really look at to give you a real analysis. Do you think Open is sinking? Yeah, I don't really like Open Door. Open Door just flips houses, and quite frankly, they're not good at it. I've been to some Open Doors before. They don't get the repair they need. So even Morningstar says they're overvalued. A persistent lack of profitability and deteriorating cash flow requires significant caution. Well, what are the cash flows? So look at this, just revenue, the lifeblood of the company. The revenue's down 37 after it fell 2.3, after it fell 62, after it fell 39. That's insane. So yeah, there's kind of the trend of the revenue, back when rates were really low. And so very interest rate sensitive stock. When rates were 0 in 2021, the stock was booming, $5 billion of revenue. Now it's under $1 billion of revenue a quarter. So it's like literally revenue's down 40 after it fell 3, after it fell 70, after it fell 40. Isn't that like ridiculous to say? But what about the net income? Ooh, so they lost 170 mil, $1 billion, 90 mil, 30 mil. So kind of just for all of eternity, this company just loses net income every quarter. So yeah, nothing's really blowing me away there. I remember there were some investors saying this was a crazy, like back down here, this is a crazy returner because they thought interest rates were going to get cut. But anyway, yeah, I wouldn't buy Open Door. unless maybe for some fun day trade or short-term swing trade, but I would not trust that one for the long term. Because there's a lot of interest rate sensitive sectors. Pershing Square, oh, this is Bill Ackman's portfolio. Yeah, this is basically a mini Berkshire Hathaway. They own a big stake into Meta, into Google, into Universal Music Group. Are we able to see their top holdings just like right here? 33 billion assets under management. I want to see their top holdings by breakdown. Investor relations, yes. Space. Well, anyway, I don't think we're going to be able to find it, but I know they own a bunch of stakes. They're trying to be a Berkshire Hathaway. So they also are wholly acquiring some companies as well. I think it's like Howard Hughes. Howard Hughes, HHH, is this a stock they're trying to buy? Yeah, look at this. So Pershing Square, that stock we just looked at, Pershing Square, they own 47% of Howard Hughes. They're trying to buy this whole company, and like, so this whole stock is now going to be under their assets under management. So, all right, next up here, Eric, what's up? He says McDonald's stock. Yeah, man, I'm actually surprised this one's fallen so much. So I'm actually a big fan of McDonald's. It's really boring to a lot of people, just some boring blue chip, but it's a fascinating business model. It's really a real estate royalty company. 80% of all the McDonald's stores are franchises, and those franchises don't own the land under the stores. The corporation owns the land. So every franchise is actually a tenant that pays rent back to the parent company. And also all of the tenants as well pay back royalties, because all the franchises benefit from all the sales and marketing from the main corporation. So they have to pay a 4.5% sales and marketing royalty on every transaction back to this parent company. So that's why they have such high margins, because they're not a restaurant company. They're really a whole different business model, real estate and royalty with the 2.6% dividend yield. You should get 2.7% dividends, 2% share buybacks, and then the same-store sales growth grows by 2.5% a year. So total return, you should get 7% of your money back a year with McDonald's. And I'm a big shareholder at McDonald's. Is CEG the same as GEV? No, not at all. These are two different companies. You know, Constellation Energy, this is a nuclear reactor company. They own, and they're the PJM company. ERCOT, they do the auctions providing electricity to houses and retail customers and businesses. But CEG owns 33% of all the U.S.'s nuclear reactors. When GE Vernova, this is the company that sells the turbines to data centers. So under every single data center are two backup diesel generators, because if the electricity grid goes offline, these data centers can't afford to go offline. So there's backup diesel generators under every data center, and GE Vernova is the main winner. They actually, you won't believe this, they have a $600 billion backlog. But here's what Morningstar says. They're reasonably valued. I actually think they're overvalued, but Morningstar has a $1,000 fair value. Its leading position in gas turbine markets, and strong tailwinds from the multi-generational electrical supercycle will drive long-term value growth. I totally agree. I want to buy the companies doing the electrical infrastructure work, the MEP work, the HVAC work for data centers. And GE Vernova is a great example. Comfort Systems, another one that does the HVAC work. Powell Industries for the MEP work, the complex electrical switchgear work for data centers. They just received a $490 million data center order from one customer, $490 million data center order, their largest order in history, and the stock rallied on that. It was so impressive. They have no debt too. Actually, both of these companies, Comfort Systems, no debt, ton of cash. Powell Industries, no debt, ton of cash. Okay, what's up? I'm so behind on the chat here. I do apologize. Faker said KEEL. What is Keel? Keel Infrastructure. Then we'll look at, hey, what's up? We'll look at HubSpot after this. And then ALM, Oracle, some of these other great ones. Yeah, actually, let's do Oracle or Keel Infrastructure. Yeah, hey, you said Oracle too. I'm actually going to do Oracle instead of Keel that you said, because I know more about this company. So Oracle, this is a pure cloud play, because there's AWS, there's Google Cloud, but whenever you buy Amazon on Google Cloud or Google stock, it's not a pure cloud play. When Oracle is like a pure cloud play, the cloud is the only thing they do. When Google owns YouTube and Amazon has their e-commerce business and stuff. It's not pure cloud. But anyway, the number one market share for cloud is AWS, then it's Azure Cloud, then it's Google Cloud, and then it's Oracle. So Oracle has the fourth largest market share. They have an incredible backlog. You won't believe this. It's the third line here. Remaining performance obligations, which is money obligated to them, reached $553 billion. So they're owed $553 billion, up 325% year over year. That backlog is fueled by large AI contracts and new AI-powered SaaS product launches. That's just like great stability into the future. Morningstar says they're undervalued, soaring demand for cloud. Yeah. So the valuation is kind of pricey though, a 32 forward PE. I mean, that's actually the same valuation as Google and Amazon's. And actually, Microsoft's the cheapest cloud play. Microsoft's at a 22 forward PE and is the second largest cloud market share. So I think Google's great. But they also own some other stuff. Like, did you know Oracle owns 10% of TikTok USA? So for the people on TikTok watching, hey, they own 10% of it. But yeah, they also are a bit leveraged and have a free cash flow problem. So if we go to the FCF, which stands for free cash flow, look at this, a negative 11 bill, negative 10 bill. So they're negative a ton of free cash flow because they're spending more than they're making. Remember, they have a $500 billion backlog. To fulfill these orders, they have to spend way more than they're currently making. Like, look, this quarter in cash and investing activities, they spent $20 billion. And they spent $7 billion, $9 billion, $9 billion. They don't make $9 billion a quarter. They only make $3 billion. So they're taking out a ton of debt right now. And that's how they're basically going to fulfill their backlog. So they have to spend a bunch of money to get the money. And it's causing a free cash flow problem. But anyway, they should be good. With just that backlog is really strong. But I do like Microsoft maybe is a little better. So HubSpot, yeah, this is a Salesforce competitor, a CRM play. Dang, this stock is the same price that it was back in 2019. They have had a massive dip, but I remember this was one of the best performing like stocks after 2019. Like here was the COVID crash, and then they just grew like a maniac after, like a 10x. Can't even fit on the screen, but now they've kind of rallied down. The most impressive part is the revenue growth. Literally every quarter, the revenue hits a new record. It's not like every year the revenue hits a new record. It's every quarter. Sorry, I had to get my water there. But yeah, this is a pure growth company. The only unfortunate part is even though the revenue is super growthy, they're just now getting net income positive. So if you buy the stock right now, you are buying them the first year that they are ever profitable. And that's what's so cool. Like before today, it was a hard buy. They were losing like 30 to 100 mil in net income a quarter. Well, now it's a business that's starting to make net income every quarter. And analysts see that too. Next quarter, they're supposed to make 28 mil in net income and 55 mil in net income the quarter after. So that's the great part. And that's why it's okay that the forward PE is really high. Like look how the forward PE is getting cut by more than half. They traded 103 times current net income. It gets cut way lower to only a 44 times next year's net income because the net income is experiencing such a rapid growth just this year as they're converting from a company losing money to finally printing money. So there you go. They're just also categorized as part of the software stocks. So like Salesforce, whenever that falls, HubSpot usually falls with it because they're two similar business models. But let's see, what does Morningstar say? Or does Morningstar even cover this one? Oh yeah, here's what the bull's saying. HubSpot has made a splash in the SMB market with its freemium model, easier implementation and simple and feature-rich software. HubSpot does not have to beat out Salesforce or Microsoft, but by offering credible solutions in an expanding portfolio to the mid-market, we think it can grow rapidly in an underserved niche or niche, however people pronounce it. HubSpot's record of introduction of new solutions. Anyway, that's HubSpot. The forward PE is expensive, but it's because they're just now getting net income positive. So that could be a cool software stock to buy on the dip. Hey, yo, midnight, happy Mother's Day. Yo, happy Sunday and happy Mother's Day. Hope everyone's having a great day. So, hey, we kind of just looked at Lululemon like 10 minutes ago. If you don't mind zooming back on the YouTube stream like 10 minutes and you'll find that. So do I need to use Ko-Fi to join your Discord? Yeah, but you can also become a YouTube member and also join. If you become a YouTube member, you would also get access to the Discord. But yeah, you can also do it on Ko-Fi. And also, once you cancel your YouTube membership, you stay in the Discord forever. It's permanent access, or you can just pay. It's a $1 one time for permanent access to the Discord. I made it as cheap as possible, literally only $1. So, because I I just don't want any scammers. And I like it how it's a small community. So next up, will Duolingo ever recover? That's a great question. You know, like I can kind of see where AI is hurting them. When you say buy and hold forever, do you really mean that, or do you still follow certain sell rules? So yeah, I mean, basically, it's just like for the most part, buy and never sell. Like, and I've been sticking to that. Like, check out these top holdings. Powell Industries, I'm up 1,000% on this stock. I've never trimmed or sold a single share ever, and it's been tempting. But like Comfort Systems, I'm up $19,000 or 435%. Like I bought all my shares here. Most people, when they're up 100 or 200% on the stock, they sell it, but not me, not in this portfolio. I have a bunch of other portfolios where I don't do that. Like this, I can do whatever I want here. I don't have any rules, or I can't never sell a stock. And this is my dividend only account where every stock in here pays a dividend. But yeah, for the most part, yeah, it is a buy and never sell portfolio. Hey, Larry, good to see you, man. I hope your day is great. It is. I hope yours is too. Hope you're having a great Sunday, Larry. If you got a stock you may look at, let me know. Oh, wait, he said ASTE. Okay, let's try it. ASTE. And hey, Plasma, we'll look at VST after this. And oh, hey, T-Guns, remind me to look at Honeywell. I do like Honeywell as a aerospace and defense play. Oh, Palantir, yeah, Invar. Palantir's next, for sure. Palantir's next. Thanks for showing up. Hey, by the way, I'm actually about to end the TikTok stream and only exclusively be streaming on YouTube because TikTok just removed my For You page eligibility. But yeah, if you want to watch a stream on YouTube, my YouTube channel is called Nathan Robert. That's the best way to support me. I sell nothing. I have no course book, WhatsApp, coach, literally sell nothing. I guess I have the Discord, but I made it $1, but sell nothing, just want to give my opinion. It would mean more if you, rather than donating, it would mean more to me to just watch from YouTube and subscribe to YouTube. So anyway, here we go. ASTE stock. They are at a cheap multiple of a 17. So they only trade at 17 times next year's net income. They do infrastructure solutions and material solutions. I wonder if they like help construct or help build data centers. Looks like the infrastructure revenue, it's kind of been flat or, kind of growing low single digits on the annual basis. So yeah, dang, the revenue or the profits are struggling here. So check this out. The revenue is up by 20% year over year. So revenue's up by 20, but the actual profits are down by 50. They only made 9 million this quarter. So I guess the profits are kind of choppy. You know what I mean? When we zoom out here, the profits are a little choppy over the years, but I mean, a 17 forward, that might also be why the stock, this stock is technically the same price as they were back in 2007. I'm glad I zoomed out. And it's no wonder because the profits are the same as they were back in 2007. Yeah, look at this. Here's the profits. In 2007, they made 86 mil that full year. And for full year 2025, they only made 65 million. So they can't escape this market cap level because the profits aren't escaping this level. They can't justify a higher market cap than 1.2 billion. So it starts to make sense why these stocks struggle. Anyway, yeah, look, they missed on expectations. Analysts expected 14 mil. They only did 1. But anyway, I got to do more research on that one. I would just be very careful. It doesn't seem like that one grows very much over time. How do we see what you were investing in? Hey, I do a ton of YouTube videos of every stock that I own and on my streams at the very beginning and all the time. I do whole entire portfolio updates. I'll share with you every stock that I own, how much I'm up and down on every share. I'm fully transparent. So if you have any specific questions for me, let me know. So here's Palantir. Invar. This is a really cool company. The government's a big customer. So many police stations, the Air Force, the military use Palantir's government's software solutions. So governments half their revenue, and check out the growth rate of this business. Revenue's up 76% year over year. After grew 45, after grew 16. So the growth rate is literally growing. A 76% is the highest growth rate on the whole screen. This is what justifies the high valuation of Palantir. Like, isn't this just so impressive? And it's not just the government side that's growing, but also the commercial side with other S&P 500 companies like Google and GE Aerospace. That doubled year over year. That's up 95%, after grew 33, after grew 26. So another one where the growth rate is just growing, and that crushes expectations. Analysts expected 616 million in net income. They did 870 million in net income, an absolute gangbuster beat. And they do that every quarter. They beat like crazy last quarter and the quarter before. So the revenue was 1.6 billion, organically up 84%. On this 1.6 bill of revenue, they kept 880 million, which means their net margin is a 53% now. Look at how the margins have grown and expanded. I love margin expansion companies. You go spend $100 with them, they keep $53 after tax. And a huge cherry on top, a huge safety net, is the fact that they have no debt. Palantir is a debt-free company with $8 billion of cash, and notice their cash just grows every quarter because whenever they make $800 million net income and also $900 million of free cash flow, they don't have any debt to pay. They don't owe anyone any money, so they just retain it. And did I just unplug my mic? Okay, good. I did not. Okay. So yeah, Palantir, phenomenal one. The only bad part is Invar, they're expensive. Like that forward multiple is really expensive. Okay, so let's do race right here, Ferrari. So let's check out their earnings right here. They are, I've always loved this one. It's like a pricing power play because if inflation is hurting Ferrari's input cost, I feel like the customers, like the rich get richer. I feel like there's more millionaires than ever before. With the stock market at all-time highs, there's more millionaires than ever before. I feel like Ferrari should be doing good on that. And if Ferrari has inflation tariff cost where they have to raise prices, Ferrari customers are the people who can afford the price increases. And check this out. Here's their USR. So this is a European company, but we've converted their currency to US dollars. They make 500 mil of net income a quarter. What I am most impressed about is this net margin. They run at 20% plus net margins. That is unheard of in the car industry. If you look at Lamborghini stock, if you look at Ford, if you look at Tesla, you look at NIO, you look at General Motors, any other car stock that exists, their margin is less than 10%. But Ferrari, they have the pricing power. This is my favorite car stock. You get a good dividend as well. You buy the stock right now, you get over 1% of your money back just in a dividend every year. Let's see. So the automotive segment saw 4.4% shipment decline due to model changeovers, but revenue grew through premium pricing and personalization. So their actual shipments declined, but their pricing power made the revenue grow. Cool. That might also be why they're maybe struggling if shipments are falling. All right, next up. Hey, Robert, how's it going, mate? Thinking of buying Netflix and ServiceNow. Yeah, Netflix I'm a huge fan of. You know, if you pay for a Netflix subscription, why not own some of the stock as well? Because they've been one of the best performing stocks ever. And it's a really simple business model to understand. Just a subscription model company. And analysts love subscription model companies because the revenue is predictable, it's reoccurring, and they have basically 300 million premium subscribers that pay them money every month. And here's their after-tax net income. Their net income had a one-time adjustment. It was slightly adjusted higher because they received a termination fee from them not acquiring Warner Bros. Discovery. Yeah, look at this. Warner Bros. Discovery pays $2.8 billion termination fee to Netflix. Well, I'm glad that the news is right there. That's why the net income grew so much. It wasn't actually $5.2 billion. You know, before tax, it was $3.9 billion. So after tax, it can't be 4.29. That adjustment was because of this free $2.8 billion they got from them. Anywho, this company makes $3 billion in net income a quarter, running at 20% to 25% net margins. They print free cash flow as well. And, you know, I have nothing bad to say. The forward PE is now cheap. This is like an S&P 500 type multiple, a 26 forward PE. So they only trade at 26 times net income. And Netflix has the pricing power. Netflix actually just rose their prices. And I don't know about y'all, but we're not canceling our Netflix subscription. So I guess they have the pricing power. They might have some churn, but people always end up back subscribing to it. But anyway, I know there's always like boycotts around Netflix. And they actually did this quarter. They announced they lost 2% streaming market share. So it's actually a kind of rough look. They're raising prices while they lost 2% streaming market share. So that's kind of one of the reasons why they fell on earnings. But overall, I think all the risks are fairly priced in at only a 26 forward PE. They only trade at 26 times next year's net income. And I like subscription model companies. Oh yeah, VSD. Are you going to own Palantir at what price? Yeah, much cheaper. They're at like a 91 forward PE, probably like 10 to 20% lower. I know I can't get Palantir at a valuation I'd want to pay because they always trade expensive and they deserve to. Bought it a while ago and I'm actually losing money on them. Oh dang. On Netflix. Yeah, hey, that's a long-term hold though. These are just buy and never sell type stocks. Here's Vistra Energy. This is another nuclear company. They own, I think, 5 nuclear reactors. So you really, Vistra to acquire Cognitrix natural gas portfolio for $2.3 billion plus shares. Cool. And they achieve an investment credit rating from second major agency. Was it Fitch or S&P Global or Moody's? Oh, it was Fitch. Fitch gave them a credit rating, and Vistra Trades, you really value them on a forward PE because they had a one-time adjustment. Yeah, look at that forward multiple at 15.9 forward PE. It's a utility company. So, yeah, they basically just sell energy to data centers and to retail. So, headquartered in Texas. And they own like 5 nuclear reactors. Let's see if there's any specific news. The East segment's EBITDA rose 56%. The Texas segment adjusted EBITDA increased 20%. Recent acquisitions, including Lotus, contributed to revenue growth, while strategic contracts like the Meta PAA enhance long-term capacity and earnings visibility. Oh, cool. I didn't know they had a Meta deal. Because any other specific news? I don't know. Anyway, a 17 forward PE seems pretty fair. They remind me, they're like a smaller Constellation Energy. If you like them, you'll also love Constellation Energy. This is the #1 nuclear company, and they report earnings tomorrow. So wish me luck, because they report earnings tomorrow morning. Wow, I didn't even know that. I'll show you my position in them. This company owns 30% of all the US's nuclear reactors. Ticker symbol CEG, they're the #1 play. The second play is actually Vistra Energy, the stock we just looked at with 5 reactors. Then I think it's Berkshire Hathaway Energy. Yeah, Luke, I need to charge my phone, I know. Do you think BlackRock are quality buys? I do. I actually really like BlackRock stock. Actually, should we cover BlackRock? I'll cover the one thing I want to cover on BlackRock. Oh, hey, actually, my brokerage is telling me that there is a double bottom, a 93% rise probability, I guess is what the analysts are forecasting. But anyway, you get a great dividend. If you buy BlackRock right now, you get a 2% dividend. And whenever you click on a stock, like any random company, let's just do Apple, for example. If you've ever noticed, click on Apple and you go to shareholders, you'll always see BlackRock as a huge shareholder. BlackRock owns 7.8% of all the shares of Apple. It's not actually BlackRock. A lot of people say like BlackRock and Vanguard, they control the world. They don't understand that. It's actually, they own ETFs. So BlackRock owns a bunch of S&P 500 and QQQ ETFs, the iShares ETF platform that manage Apple stock for their customers. So BlackRock, the ones that custody the Apple shares. So it says they own it, but it's really the customers that own the ETFs that own that those shares of Apple. Anyway, BlackRock, I love the ETFs, and specifically, they own the IBIT ETF. They have a Bitcoin and an Ethereum ETF that just came out, and check out what that did to their alternatives revenue. It went year over year from full year 2024, went from 1.76 to 3 billion. It grew 72% year over year, their alternatives revenue, which is incredible. They also have a technology subscription business. Look at that. That's up 21%, also hits a new record every year. I just know their private equity business is why the stock is struggling, because they had like record withdrawal weights. Yeah, look at that. The kind of the bearish line right there. BlackRock and Blackstone mark down private credit fund valuations amid portfolio adjustments. So they're seeing a lot of withdrawals. People are withdrawing their money. Like one of their funds, like 10% of all the assets were being withdrawn in 1 month. But that crisis really is over. So, what about Grab? Hey, what's up, Thon? He says, what about Grab? I'm thinking about buying calls. So this is a company Uber owns. So if you're wondering what is Grab, what does Grab do? This is international Uber. They do ride sharing in international markets. So if we go to where the revenue comes from, what I like about them is notice the US and Canada and UK isn't on here. It's mainly these like developing nichier countries like Malaysia is their largest, then Singapore, Indonesia, Philippines, Thailand, Vietnam. This is a commodity. This is a commodity that's universally needed, no matter the country. People want food delivered to them. People need ride sharing, and Grab does it internationally, and they're the most profitable they've ever been, and the growthiest they've ever been. Revenue hit a record this quarter, and this is in US dollars, 955 mil of revenue, a record, and on that 955 mil of revenue, look at them the past year. They're making close to 100 mil in profits of net income a quarter. If we zoom out, it used to be a tough buy. They were losing 100 to 200 mil a quarter, but no, this is now a very profitable company. And they still have a slight bit expensive of a forward PE, but that's because this is the first year ever that they're profitable. So you really judge them on a forward PE. The forward PE is a 33. And you really want to do like a 2-year out forward multiple. So Anyway, I'm a fan of Grab. And if we go to the largest shareholder, this is genius by Uber. Uber is the largest shareholder. They own 13% of the company, which is great because that's not new competition. Uber was having a hard time getting into these international markets because they already dominate US, Canada, UK. So for a great way for Uber to get international exposure, they're like, hey, let's just buy Grab. Let's just be the largest shareholder. So yeah, Uber is the largest shareholder of that company, which I do own. I did just buy a bunch of Uber. Actually, Uber, check this out. Uber owns a bunch of they own 535 million Grab shares, 300 million Aurora Innovation shares, which is AUR, 13 million Lucid, a bunch of WeRide, Joby Aviation, Serve Robotics, Marquita. I freaking love what Uber is doing with these acquisitions. But anyway, I'm also a big fan of actual Grab. Okay, Chris said SAF. Let's check it out. SAF is actually, I can't find that stock. I did look it up though. Unless you're talking about this bond right here. This is a bond, I believe. And there's no like earnings or anything I can look at because it's just like an owed note. So let me know what you're talking about there, Chris. Or if you have a different stock, let me know. I love CEG, but I like the cheapness of Vistra. Yeah, hey, we'll find out with earnings tomorrow. I'm super curious to see what happens with CEG. Hey, what's up, Vicious? Appreciate for all you do. I've learned a lot, and you helped me build my portfolio. Hey, thanks, man. I appreciate you watching. I just enjoy talking about this stuff. I'm surprised so many people show up. Hey, yeah, if y'all are enjoying, please hit the like button. Please subscribe. We stream every Sunday at this exact same time. Dang, I've been live for 2 hours and 55 minutes. It's one of my longest streams ever, nearly a 3-hour stream. I didn't even realize time's been flying by. So, Edward, what's up, man? Also, check the net margins on VRSN. Oh, VeriSign. Oh, yeah, this is that .com.net company. Check this out. I'll be really quick with this one because we kind of just analyzed them. But it's the first line. It says, it's exclusive regulatory control over .com and .net domains and consistent price hikes provide highly predictable and durable cash flows. Interesting. And let's see what their net margin is, the viewer asked. Wow, hey. Thanks for telling me to check that. They have a 50% net margin. So let's see. The revenue was 428 mil. On this 428 mil of revenue, yeah, they kept after tax 214 mil. Yeah, the before tax was 290. So that's real. They really do have a 50% after tax net margin. That's pretty cool. That's a money printer. They're basically collecting royalties. Do you invest in Taiwan or Brazilian markets? I actually don't. But I would love to own Taiwan Semiconductor. I'm just waiting for the right price. Taiwan Semiconductor is one of my favorite stocks in the market. Do you invest in Tesla yet? Copper plays, GLD? Yeah, I love copper plays, specifically Amphenol. This is the company, I kid you not, they provide copper cables to Nvidia's NVLink spine. The NVLink spine uses over 2 miles of copper cables in this tiny box, and that's actually provided by Amphenol. Amphenol also provides the copper cables to Google's custom TPUs, and they only traded a 24 forward PE. But I'm assuming if you mean copper, you want a more like, this is a copper commodity company, FCX. This is the best copper stock in my opinion, Freeport, McRowan. And check this out. You get a good dividend, basically a 1% dividend yield. And look how consistent their net income is. Every quarter, they're constantly making, if we average it out, close to $1 billion in net income a quarter. So the consistency of the net income just impresses me on FCX. So that's like your pure copper play. But Amphenol's more of like a specialty copper company. I've seen their facilities. They just have spools of like virgin copper ready to be used. And GLD, yeah, gold. A lot of people know the gold ETF, GLD and IAU. So yeah, IAU is literally just the commodity of gold in an ETF. So if you want to invest in gold, it's almost better to buy the ETF because when you buy physical gold, especially in smaller quantities, you're paying a spot fee and it's really high, especially the smaller quantity gold you buy. And let's say you go and buy a lot of gold. Well, now you have to store it. And sometimes you have to pay for a vault if you have a crazy amount of it. So you pay for a vault. So sometimes it can actually be cheaper and more liquid to buy the gold ETF because whenever you want to sell the gold, you got to go to a pawn shop or whatever, pay the spot fee to sell it. But with the ETF of gold, you can just sell it instantly, buy and sell instantly whenever you want. And IAUM is the cheapest gold ETF. It has only a 0.09% expense ratio. So you're only paying 0.09% in a fee a year. It's run by BlackRock or iShares, which is BlackRock. So yeah. Next up, we got, what is this one here? What's up, Investing Vibes? He says, PA&W, Palo Alto Network is one of my favorite stocks. Well, fortunately, they're super pricey, but they're a cybersecurity company. I love the cybersecurity industry specifically, and over half of the S&P 500 are customers of Palo Alto. This is a subscription model company too. Oh yeah, they break it down for us. Perfect. So look at this. Half of this company's revenue comes from their subscription business, and check out the annual growth. This is what you want to see if you're going to diamond hand a stock, where every year the revenue hits a new record. And this is subscription revenue, reoccurring, highly predictable, high margin. It's great. And they're already profitable too. Like Palo Alto Networks isn't some startup. They're already printing money, a couple $100 million of after-tax net income a quarter. Yeah, and the revenue just hits a record every quarter. So I'm very impressed. There's just, they just reported earnings too, I think. Let me look at those. So, what was it down here? Weekly news? Actually, there is no news really. Oh, well. But yeah, look at the future projections. Revenue in 2 quarters, if you see on the very right, is going to $3.28 billion. It's never even been close to $3 billion before. So there is significant future growth happening just in the next 6 months. So I would hold on to this one, except the tough part is about buying now. You can't really buy the stock now because look at that forward PE. They traded 101 times next year's net income, but they are owed $16 billion. So the retaining performance obligation is contracted. It's basically contracted backlog. So actually, Morningstar even has them as undervalued, with the $225 fair value, a strong secular tailwind in platform consolidation, robust AI-driven security adoption, and a massive ecosystem generating high switching costs will drive long-term value growth. Cool. So George said RMBS. Let's check out. Oh my, they're saying I'm AFK again. Dang, they've upped their freaking captchas. Dang. All right. I'm in live for 3 hours. They thought I'm at AFK. So here's Rambus right here. I forget what this company does. They might be some semiconductor company. So Rambus, is there any news? No. So semiconductor space. Okay, so they are in the semiconductor industry. There is good revenue growth too. Revenue is supposed to hit 210 mil in 2 quarters. And they're supposed to keep 72 mil in net income. So they're already highly profitable. Yeah, they're making 50 to 60 million of net income a quarter. And this is a great safety net. Takes a lot of risk off the table when they have no debt. This is a debt-free company. They have 786 million of cash. What's the market cap? We're $13 billion. So 5% of the market cap is their cash on hand. That helps the forward PE because, yeah, they are expensive. That's the tough part. A 48 forward PE. But they do have good EPS growth. Net income's almost supposed to double to 48 mil to 72 mil. So, and the revenue is growing. So there is nice future growth. I love the Fortress balance sheet. I love the margins, 33% net margins. It's just slightly expensive at that multiple, but everything AI is like AMD is even really expensive. Texas Instruments, Intel, they're all really expensive. And that might be just a similar company. So Jonas said, can you look at MP Materials? Yeah, I believe the government took a stake into this stock right here. So they own some rare earth mineral mines in the US. So MP Material reports earnings with record NdPr, which is an element like ticker symbol. I don't know what NdPr is, production, but it's some sort of Rio production was up 13,000 metric tons. Okay. MP Materials to commission heavy rare earth separation circuit. Okay. So for magnetics facility, interesting there. Well, let me check out shareholders. Okay. I guess it won't show it. But yeah, look at the future growth projections. So this company is getting their first ever sort of revenue from their mines. It's at 90 million this quarter. It's going to hit 95 mil the quarter after and 126 million the quarter after. And they're actually supposed to make 1 million of net income on that. I want to see more specific updates on the exact minerals that they mine. Extraction, Mountain Pass, California, they extract, refine, and manufacture, used for a bunch of different industries. Anyway, I do more research for you, but I don't have forever. But NdPr production, it's a hard buy, though, at current valuations. It kind of just trades off the geopolitical fears. Yeah, a 416 forward PE, so it is really expensive. But there is a lot of future growth happening. Yeah, look how they beat. Analysts expected 75 mil. They did 90 million. MP Materials forecast Q2 NdPr rare earth prices at low to mid $90 per kilogram. All right. Okay, so that stands for neodymium praseodymium dimum. Something, the third line there. Okay, whatever. Let's go to the next stock there. I know the U.S. government, I believe the U.S. government has a 10% stake into that stock. I know they have a 10% stock in USA Rare Earth. And, or was it LAC? It was LAC. The government took a 10% stake in Lithium Americas as well. Any specific news over here? Nah. All right, let's keep going here. 103, 1013. What do you think of MRAM? What is that one? How is mining company, specifically aluminum and zinc? Hey, what's the ticker symbol for that stock right there? Hey, what's up, James? We'll look at ASTS after this. Yeah. Hey, I'm sorry I'm late. How about ADR? Hey, no problem there, 1961. Thanks for showing up. So here's MRAM. Yeah, $600 million company. They're up 25% on Friday. Is there any like intelligent comments that can tell us what happened here? I don't know. Because there's got to be some sort of good news for it to rally 25% and then another 35% after hours. So there is some future growth expectations. Revenue is going to go to 18 mil, and they're actually going to make profits on that. So normally when companies have such little revenue, they're still really far away from making money. But this company actually only lost 300K. They made money last quarter, and they have no debt. Actually, this company's fundamentals look really good. No debt. 85 mil of cash. So net income, just going to lose 250K next quarter, but then make 450K. So they're basically losing no money. That's good. So UFO ETF, that's a space ETF. Yeah. So the Procure Space ETF, it's done phenomenal. It's at an all-time high. It's mainly a lot of these space stocks have been rallying from the momentum around the SpaceX IPO and the Artemis 2 mission launch. So yeah, Planet Labs, that's a phenomenal stock owned by Google. 10% of all the shares are owned by Alphabet, which is Google. They do the satellite data for Google Maps. Then Viasat, Global Star, which just got acquired by Amazon. So that's why the stock looks kind of weird the past 2 weeks. Amazon just bought this company. So there's just a lot of momentum around this industry right now. SiriusXM, Rocket Lab. So we said compared to ASTS. Yeah, ASTS is another one where they're just like you're buying them as they're transitioning into a company with real revenue. So you really just look at the future growth expectations. If you're a shareholder of ASTS, you really want to hold this one throughout the next two quarters, two earnings reports, because these are the most crucial earnings reports you'll ever have. Because if we zoom out before today, look at this. They did 55 mil of revenue. Before today, they were doing $1 million of revenue a quarter, no revenue. And then all of a sudden, boom, 55 mil of revenue this quarter. And the growth is not done. Next quarter, analysts expect 37 mil and then 39 million the quarter after. So they're now going to be making like 200 million of revenue a year, up from 4 million a year ago. So that's kind of the bull case around ASTS Space Mobile. Is there any specific news? Let's see. ASTS receives FCC authorization to deploy and operate up to 250 satellites. Cool. Rakuten Mobile complete sale of 5.5 million ASTS space shares. Oh, they reduced their stake to 5.3%. No big deal. ASTS fails to meet satellite deployment milestone by February. CEO receives zero payout on performance-based compensation. Oh, wow. As a result, CEO received zero payout for that portion of his 14 million compensation tied to execution milestones. So he didn't get that 15 mil. Hey, that's good for shareholders, though. All right, next up, we got CSCO. So this is they acquired Splunk a while back. This is a cool software dividend growth stock. So as we know, a lot of software stocks are struggling, Adobe, Microsoft, Salesforce, HubSpot, but Cisco is at an all-time high. I'm shocked. And I think it's because of their cybersecurity industry. So they acquired Splunk. I used to actually own Splunk stock back a while ago, but they acquired Splunk, and look what that did to their security business. It's not organic revenue growth, but yeah, from full year 2024 to 2025, it grew 59% year over year. incredible growth over there. They just are a money printer. If we just go to after-tax net income, Cisco makes 2.5 to 3 billion. It's growing, it's up 30%. They made 3.2 billion in net income this quarter, and they have a 1.7% dividend yield. So they're a little expensive though today. Actually, I would not buy today at a 30 forward PE, but I love the dividend. Like you buy even now a 1.7% dividend plus the stock price appreciation. Like you've gotten a 2% dividend nearly plus the like 5 to 7% stock price appreciation they do every year. So it's been a nice company to keep up with the S&P. Look at the future revenue projections. It's up to the right. Net income's up and to the right. They're beating on net income projections every quarter. 20% net margins. So cool dividend growth stock. So ADUR, I'm so behind here. My bad there for taking so long, 1961. We'll look at Progressive after this. What's up, James2285 and Chris and FICO. Hey, what's up, guy? So, and Monkey D. Luffy and Mr. Powell. Hey, what's up, y'all? Hey, y'all should head over to the YouTube stream. It's popping over there. But what's up, Mr. Powell? I've actually been looking into getting into APH, so I might start a position with it being down decent. I actually totally agree, investing vibes. I'm actually about to buy more. Infinite as well. So someone said, what's the difference between gross profit and net profit? Yeah, so there's certain things that aren't included in gross versus net profit, like taxes and a stock-based comp and certain gap, things like that. So you really always want to compare the two, because I like to check, because sometimes the net profit is higher than the gross profit. Tesla frequently does that, and that means there's an accounting trick. So anyway, let's look at ADUR. This is Aduro Clean Technologies, a very small company worth 455 million. So that's just such a small company. So you just want to be careful. They're worth 450 million, but I can also see why they're worth so little, because they do no revenue. The revenue this quarter was 87,000. So that's just like no revenue, 87,000, and they lost $1 million on that. They lose 1 to 4 million a quarter, which is unfortunate. Like that doesn't sound like a lot, but when you lose 20 mil a year, that's a pretty big deal when you're only worth $455 million. So it's kind of tough to value this one because there is no forward PE. So they're not supposed to make any net income anytime soon. So developing environmentally responsible, let me go to their website. Someone said, what app is this? Yeah, hey, Signal Beam. This is an app called Moomoo. It's actually a brokerage where you buy stocks on. It's actually the first link in the description if you'd like to use my affiliate link. So hydrochemalotic, or I don't know, upgrading bitumen, lighter crude. So I'm upcycling plastics, upgrading renewables. Well, they don't do that much money. They're headquartered in Canada, Ontario, Canada. So anyway, actually revenue is supposed to go up to 350K in 2 quarters, but you just want to be careful with that one just because it's still so early. So Progressive, this is a cool insurance company I do own. So I'll show you that right here. I'm down 20%. I'm not technically down 20% because part of that's the dividend payment. So anyway, here is Progressive. I love insurance companies, and this one pays a special dividend every year. I'll start it off by covering that. Actually, let me pull it up over here. So look on the very right. You see the first line, it says 10-cent dividend. Look at the quarter before that. It says a $13.50 special dividend. In the 1 year before that, they did a $4.50 special dividend. A year before, a 75-cent special dividend. They're paying out these special dividends that they don't have to. They're just rewarding the shareholders because they're the most profitable they've ever been. If we zoom out on the net income, look at how consistent it is now. Look at these growth rates at the bottom, these year-over-year growth rates. They literally make an after-tax net income 2.6 to 3.2 billion in net income a quarter. Oh, and fun fact, we got rear-ended twice this month. Both people had Progressive. So we dealt with the same agent. It was kind of funny. But anyway, they're printing 2.8 billion net income a quarter. And it says the dividend yields is 7%. It's not actually, that's just including the special dividend. But I'll go ahead and show you my special dividend I got from Progressive. If I head over here, over the past year in this account, we've received $245 in dividends. And the largest payment was Progressive, $55 special dividend. We also got a special dividend from Futu, a $36 special dividend from them. Anyway, yeah, here's my lifetime performance in Europe. We're only up 24% all time. So don't listen to me. I'm not an expert. But Progressive, I just like as an insurance company. Here are the personal lines. Like if we just look at the business, like it grows double digits, Just like on an annual basis, that's what you want to see. So they still grow, and they're just off all-time highs as well. And I do own them, so I'm totally biased. But so SAF Safran is a Paris company. Let me see if I can find it for you. SAFRAN. We found it. Okay, so it's a weird ticker symbol, SAFRY, but we found it for you. Let me know. I hope this is the right company you're talking about. They're actually a European ADR, so we'll convert the currency to US dollars to get a better idea. So they do propulsion and equipment in defense. Aircraft interiors, that's pretty nichey. That's actually pretty cool. You get a 1% dividend. If you buy it right now, you get 1% dividend. That's actually really cool. Let's see if we can check out their website. Fraud and identity theft related to Chevron shares. What does that mean? Fraud and identity theft related to the shares. What is, I don't know what that means. So hopefully they didn't just collect my IP. I'm just kidding. But cool. Aircraft equipment, aircraft interiors. It'd be fun to do more research onto this company. Oh, I'll put them on the watch list for the fun of it. So what's the forward PE? Do they have one? So a 30 forward PE, that's actually reasonable for the aerospace and defense industry. Like that's what Raytheon trades at. That's what, what's the other one? Like there's BAE Systems. There's another one in Europe that's a big aerospace and defense company. Well, there's Rolls-Royce as well, but there's another one I'm forgetting. Anyway, so since this is a European company, they report in halves. So that's why it says FY, which is full year, and H1, which is first half. So they report in half and full years. But full year 2025, they did 8.5 billion net income. Pretty crazy. That must be why the stock is doing so well. Next up, we got, FICO score. Yeah, they've just had some increased competition from the, what's it called? The something score. There's another score that just came, a Vantage score, I believe it's called. And the Vantage score just got allowed to expand in a much bigger territory. Anyway, let me see if I can find that in the Morningstar research here. So, where's the best say? So, yeah, the third line here, the FHFA decision to allow Vantage score for government mortgages will alter its pricing strategy and could result in Vantage score gaining traction in both mortgage and non-mortgage markets. So anyway, original business model of FICO was fascinating. Basically, they integrated with all the banks. Basically, every time you make a big ticket purchase, you buy a car or a house, you pay a couple dollars for your FICO score. No one really cares. It's just a couple dollars. So they've had tremendous pricing power. Wow, it grew 60% year over year. They've had tremendous pricing power. They're like, hey, who cares if we double the price? People will still pay $10 if they're buying a six-figure house, for their FICO scores. They don't really care. But now looks like there's other scores that are being allowed on the market. But this valuation and those fears seem to have potentially almost been fully priced in. They're at a 26 forward PE, and their score business crushed analyst expectations. Analysts expected 620. They did 690 mil of revenue. And they expected 225 in net income. They did 265. That was a great beat. So they really only traded at 26 times forward PE, which in my opinion, it's a good time to nibble on them. Now, the Vantage scores problem is still real. So I wouldn't go meaningfully buying the dip. Like if I wanted this as 5% of my portfolio, I wouldn't make it 5% of my portfolio today, but I'd go ahead and make it like 1% of my portfolio, because that actually, I'm really impressed. Sorry, my phone is lagging here. My phone battery's getting low here. And my phone charger port on my computer is broken, so every time I move the cord weird, it unplugs, which is just great. Oh, hey, investing vibes. You still in here? Well, check out Amphenol. I totally forgot about that one. I'm kind of just mainly reading the YouTube chat. Hey, and Luffy, if you're still in here, we'll look at Viva Systems. So let's do PGY right here. What's up, Big Barney? So this is Pagaya Technologies or Pagaya, I don't know, whatever. This is a cool software company, and they're very cheap. Like, I don't think they can go any cheaper, and that's the real thesis around this company right here. If we just value them on a net income multiple, I'm lagging. Hopefully it's not lagging too bad. The kilobytes on the OBS just went to 1,000. It's supposed to be at 10,000 to run smoothly for context. So, it's like red. Oh, geez. So sorry if it's lagging. That's my fault. Let me type that in the chat here. Oh, man, it actually just ended the stream. Well, hey, I've been streaming for 3 hours and 20 minutes. If it ends the stream, then, oh, well. I've been streaming for very long anyway. We're almost back. Okay. Okay. We're fully back now. Okay. For real, we're back. It says it's fully back. Okay. Anyway, the stock trades at a 13 PE, but look at next year's PE. It's all the way down to an 8.5. They only trade at 8.5 times next year's net income. And look at the net income projections. Next quarter, they're expecting 31 million, 38 million the quarter after. That's going to grow from 22 million. So that's incredible growth, because considering the whole company is worth only $1 billion or, $1.26 billion, making well over 100 million a year is crazy. So that's why they really do only trade at a 8.5 times next year's net income. That's just a ridiculously cheap valuation. I can't believe it. Let me see what they actually do. Let me pull up their website. So its products deploy data science machine learnings to evaluate customer applications in real time. Oh yeah, it's like a customer relationship like solution company. You integrate them and you get more customers approved or something like that. I don't even know. So keep more borrowers, retain customers who don't meet your credit criteria, grow without risk, build loyalty. Okay, cool. Anyway, they have real numbers. I mean, those net income numbers are real, but the stock has been struggling because all of software stocks have been struggling, and maybe there's some specific news I don't know about that company. Like maybe Claude Code does the same thing. Hey Larry, what is AAXJ? Or is that like the all country Asia ex Japan ETF? Wow, actually, it's at an all-time high. So the Asia ex Japan ETF, what does it own? Obviously stocks. Oh yeah, like Taiwan Semi, Samsung, SK. Those are crazy memory shortage plays. Tencent, Alibaba. Actually, they have great holdings. I'm impressed. No wonder the ETF is at an all-time high. Usually these international market ETFs don't do as good as the US markets, but that one did really well. James says, I wish Nvidia gave a decent dividend. Yeah, but at least Nvidia makes up for it in stock price appreciation. So like you'll still get it, like you'll still get 8 or 10% of your money back a year. But yeah, I know what you mean. When we go to the dividend, it's a 0.02. But that also means maybe in the future, there's going to be a lot more dividend growth. But yeah, 25 forward PE. As you know, whenever the stock price goes up, the yield goes lower. So if you want Nvidia with the yield, Taiwan Semiconductor is actually pretty good. Nvidia just designs the chips. Taiwan Semiconductor actually manufactures them, and they have close to a 1% dividend yield. Check Crimson Burger. I heard it would skyrocket. What is Crimson Burger? Is that a I'll type out the name for you. Crimson. Yeah, I can't find that one. If you have a stock right there, give me the ticker symbol and I can find it for you. ETF, ARM. Oh, ARM right here. So ARM, this is a really fascinating company. If you didn't know, ARM is really a licensing and royalty company, believe it or not. Or they used to break it down. So check this out. 60% of their revenue is their royalty revenue, and 41% of their business is their licensing revenue. So when we go to their gross margins, they are rocking a 97% gross margin. That is ridiculous. A 97% gross margin. Then they have a 20% net margin on that. The net margins are slowly going higher. So anyway, they're a money printer, and they actually just created their own they just made their own chip. Multiple analysts raise ARM price targets following earnings beat, citing AI CPU demand and data center growth. ARM Holdings projects company will hold the largest CPU market share by 2030, cites partnerships with Nvidia, Amazon, Google. ARM develops first data center CPU chip. So there you go. Targets $15 billion in fiscal 2031 sales. So that's some crazy good future guidance if they can pull that off. Would you invest in chips or DRAM? Yeah. Let's see what they are. So CHPS, this is the Semiconductor Select ETF. So it basically owns only semiconductor names. Yeah, like Intel, SK, AMD, Micron, Texas Instruments, Lam Research. So yeah, another one. Yeah, chips. It's kind of like the actual chips. The other one you said was DRAM. This one specifically focuses on memory. So it only holds the memory stocks like a SanDisk, Micron, Samsung, SK. Like those specifically are what they own. Seagate, WDC, Western Digital, that's what they own. Another great one is SMH. This is just the Van Eck Semiconductor ETF. So if you don't know what semiconductor stock to buy, I feel like I heard about this semiconductor hype for data centers. I want exposure to it, but I don't know which stock to buy. Do I buy Nvidia or AMD, or do I buy part of the memory shortage with Micron, or do I buy the lithography companies like Lam Research, or the fabs, the people who produce the chips like Taiwan and Intel? Well, this ETF just breaks it all up for you. You get exposure to Nvidia, Taiwan, Broadcom, AMD, Micron, Qualcomm, Lam Research. So all the best semiconductor stocks. Phenomenal ETF. So have a great day, Nathan. I'm out. Hey, see you, Larry. Thanks for showing up. Hope everyone's having a great Sunday. Happy Mother's Day too. Don't know if I'm late, DXYZ. Hey, you're not late. Don't worry. Hey, we've been streaming for over 3 hours and 30 minutes. This one actually might be my longest stream ever, but I appreciate everyone that's here. If you'd like to hit the follow button, I'd greatly appreciate that. We stream every Sunday, this exact same time. I try and stream every day, and I literally sell nothing. I have no course book, WhatsApp, Telegram. I don't sell anything. I'll never follow you, DM you, no book, no coaching. Just on here, give my opinion. So anyway, here's DXYZ. What is this stock? Oh, this is that private equity company. They own shares of SpaceX. So basically, pretty much call this an ETF. So we are looking at an ETF right now, and these are its current portfolio. 16% of its holdings are in SpaceX, then Shield AI, which I've never heard of. And then look at the third line, Beast Industries. And I bet you're wondering, don't want to, almost pull up YouTube, expose something there. But Beast Industries, this really is Mr. Beast company, like Feastables, all that. So they're not public, they're a private company, but they have shares of it. They own some XAI too. They own OpenAI. So anyway, it's an ETF that only owns private companies. Kind of reminds me of the Robinhood Venture Fund. So yeah, no problem there. Also, what app is this? Yeah, hey, this app I'm on, it's a brokerage called Moomoo. It's where you buy stocks on and analyze stocks. If you'd like to get it, it's the first link in the description, and it's an affiliate link too, so it'll help me out. But yeah, you can just type it into Google Moomoo. But yeah, first link in the description, and it's the first link in my link tree in the description somewhere there. I don't know how the description looks. But anyway, here's Viva Systems. What's up, Monkey D. Luffy? So yeah, Viva Systems, this is a cool subscription software company. I think it'll impress you because out of all the software stocks to buy on the dip, this is definitely one to look at, because if we look at their subscription revenue, it just hits a record every quarter. And I love subscription model companies. It's all reoccurring and predictable. Analysts love it. So that's up 16%. After grew 17, after grew 13, after grew 16. So incredible growth on the subscription revenue. And the professional services grew 15, which is the highest growth rate on the whole screen. And it's not just revenue they're making. So they did 835 mil of revenue. On this 835 mil of revenue, they kept after tax 244 million. So they really do have a net margin of a 30%, a 25 to 30% net margin every quarter. So they're printing net income, they're printing free cash flow every quarter. And the huge cherry on top as well is a fortress balance sheet that's unleveraged. So they have no debt, or maybe like the littlest debt, but no net debt at all. And then they make 200 plus mil of net income a quarter, over a 200 mil plus of free cash flow a quarter. So this company will, I bet, one day be paying dividends. And the valuation is now pretty fair. They traded a 25 forward PE. I assume this stock is just struggling because of all the software. It just looks like Salesforce or Adobe or applovin. It just looks similar. I don't trade stocks. How can I find good stocks to invest in? Hey, you just got to do your own research. You probably know a lot of good stocks. Think of stocks you use on a daily basis. Amazon, Google, Meta, stuff like that. Those are quality names. S&P 500 type stocks. You don't know if it's quality unless you do your own research. You got to have a criteria. My criteria is I just deep dive into the fundamentals and the financials, because that's what justifies and really moves the stock in the long run. It moves the market cap. It moves the valuation. It changes it if it can trade at a higher valuation or a lower valuation. So a lot of people like to do technical analysis and short-term swing trade patterns. I'm not good at that. I know some people are, but not me. I know when a stock is undervalued in market cap. Like if I'm like, hey, Google's at a 17 times net income. I know they're undervalued. I don't know when they're going to recover, but I know they'll eventually recover. So anyway, here's NU Holdings. This is a crypto bank out of Brazil. So for context, you need to know basically all the revenue comes from Brazil. 92% of it comes from Brazil, and then 7% Mexico. So pure South America crypto company. But that's actually great because that's where crypto for actual transactional purposes are used the most. Because here in America, we have a good currency. We just use cash and dollars, but their currency is not so good. So actually, a lot of people use crypto for transactional purposes. This is the largest crypto bank down there, and they're growing like a beast. The revenue is up 56% year over year to 4.7 bill, and this is in US dollars. And on that, they made in net income and real after-tax net income, 894 million, which means their net margin is a 19%. If we just zoom out, this is a record net income quarter. It's never even been close before. So I just love the growth that they're experiencing. All organic too, 62% net income growth, organic. Just ridiculous. So there you go. And the valuation's cheap. Part of the reason the valuation is cheap is because all the revenue comes from Brazil. They just get lower multiples, kind of like Chinese companies. They just get lower multiples. But that wouldn't scare me out of the stock. It's not going to prevent me from owning it. Like for a 16 PE for the growth that they have is totally justified. All right. Thank you for your dude. Love the videos and streams. Hey, Chief. Yo, thanks, man. Are you self-taught or did you go to school? You know, I kind of basically mostly am just self-taught. I've just learned from other people, from articles, from research reports. You know, I'm also in college right now, majoring in finance, minoring in fintech. Ooh, here we go. I saw Wix and let's do Wix real quick. This is like an e-commerce kind of competitor to Shopify. I really like Shopify as well, but Wix, I can now understand why the stock is struggling. Their net income is just went negative. So if we just zoom out to last year, they used to make good, consistent net income, like easily 30 million to 50 million net income a quarter. But now for the past 2 quarters, they've actually lost net income and are projected to continue to lose money. They're supposed to lose 4 million next quarter, and then they're supposed to make 8 million. So basically, the forward PE is all wonky. They trade at a 65 forward PE, which makes them look really expensive. So that's the unfortunate part, really expensive forward PE. But they just acquired Base 44, and this is a vibe coding company. Basically, and this is unfortunately going to be really commoditized, but basically you give it a prompt and it generates your website for you, generates your shop for you based off the prompt you tell it. And there's basically like Claude Code's doing this. But anyway, they acquired Base 44, which was one of the original, this is one of the original vibe coding plays, but looks like they just aren't growing. And they're losing way more net income than analysts ever thought they would, like net income. So I don't know. I would just be, sadly, I think this one might be able to still go lower because the forward PE is a 65. That could still go lower, or I mean higher. But so I would just be careful with Wix. So, I just downloaded Moomoo and it looks nothing like yours. Maybe you could explain. Yo, Edward, it should look pretty similar. All I've done is like tweak the layout slightly. I actually have some YouTube videos on how to use this app and stuff, how to analyze stocks. So actually, if you check out some of my previous videos, like if you were to just look up Nathan Robert Moomoo tutorial on YouTube, I have a bunch of, I think my second most popular video on YouTube is like a Moomoo tutorial, or I compare all the brokerages. So what's up? Someone said, can you please look at MOD? Yeah, what's up, Mamba? MOD, Modline Manufacturing. Then we'll look at Marvel and do you buy index funds? Yeah. What's up, Jojo? But I'm really a stock picker though, but not. So basically, no, the real answer is no. It's such a small portion of my portfolio, I can't even consider it. But I'm a huge fan of having index funds or basically ETFs. ETFs is just an index fund on an exchange, a brokerage, but ETFs I'm a huge fan of. Have that as the backbone of your portfolio. So here's Modine Manufacturing. So we're bringing the manufacturing back to America. Looks like they're in the climate solutions, which is HVAC. I love the HVAC industry. Data centers need to be cooled down. These servers will literally melt themselves and destroy themselves if they're not cooled properly. And check out their climate solutions. No wonder this stock is at an all-time high. It grew 51% year over year. That's the highest growth rate on the screen. Actually, it grew 51. After it grew 42, after it grew 2. So the growth rate is growing. Holy schmoly. And yeah, so they beat on revenue this quarter, and revenue expectations are to the moon. Revenue's going from 680 to 920. Wow. So yeah, I like the climate solutions business. I'm a big fan of HVAC. That's my largest holding is an HVAC company. So that's why the stock is rallying to an all-time high, I bet, because the growth is finally back. Just revenue's up 30%. And that's organic too. Like they didn't do an acquisition to get that 30% revenue growth. So look, revenue's up 30, profits are up by 43. When the growth rate of the profits grow faster, that means margins are expanding. Pretty cool. So yeah, I can see why they're at an all-time high. So when you say you look at fundamentals to see something undervalued, what are the main fundamentals you look at? There's a long list of stuff. Like I kind of blend so many metrics together. Like I look at competitive moat, the net income, the free cash flow, the dividend payout ratio, all the yields and stuff. So yeah, here's Marvel right here. They are a cool custom chip company. They just partnered with Google and some other companies as well. Unfortunately, the news isn't down here anymore, but they literally just had a huge partnership with Google to help them develop their TPUs. But yeah, basically the net income projections are good. Net income's going from 194 to 390. So great year-over-year increase. So yeah, if we just look at the profits, it used to be a tough buy. This stock 2 years ago was losing $100 million every quarter. It was losing money every quarter. But look at the profits now. It just hits a new record every quarter, and the growth isn't done here. It's just going to continue to climb higher. Same with revenue. If we look at the revenue projections, it's going to hit 2.4 billion, then 2.6 billion, and that's assuming they don't beat on earnings, and I bet they will with this new partnership. So one thing to note, they did just sell out of one of their low margin businesses, so that's why if we go to net income right here, it says they made 1.9 billion net income last quarter. They didn't actually. This is why we always blend. Look, here's the operating profit. Operating profit is the before tax, before interest, before adjustment number. They made 367. The net income should always be lower. So the net income being 1.9 billion means they did some one-time adjustment, and that one-time adjustment was going to their cash and investing activities. They actively sold out of one of their assets, and I looked into it. It was their one of their low-margin businesses. So yeah, if this number is ever positive in the cash and investing activities, yeah, that literally means they actively sold out of one of their assets and received cash for it. You ideally want this to always be negative. That means they're investing money into new assets, into new things like chips and data centers and land and property and all that. So anyway, the stock's at an all-time high. It's a tough one because the valuation's pretty ridiculous. And trading at 84 times net income, but with its recent partnerships, I can see why they've done so well. So next up, what is this? HIMS? So wait, is HIM even a stock? Do you mean HIMS? Yeah, if I check out HIM, I don't see that stock right there. Let's see. Next up, Innodata. What are your thoughts on Innodata? I bought 3 shares at $44. Yo, Innodata just got a crazy deal with Palantir. So basically, they had this one big tech customer. Yeah, they rose their guidance. Or let me just show you what they reported. They had a blowout quarter. Every metric they crushed on. Analysts expected 76 of revenue. They did 90. Analysts expected 2.8 million net income. They did 14 million net income, and that was real. Like the EBITDA, the earnings before interest taxes, like non-adjusted numbers, they expected 3.6. They did 16.9, and that's what justified an 86% rally in the stock price. And it really does justify it because they had a basically surprise order from Palantir. Palantir is going to make them have over 50. That's going to add 50 million of revenue to sales just this year. And check out, like, that's a meaningful amount. That's basically one whole quarter of their earnings now just new for their revenue. So wait, there we go. Okay, so yeah, Innodata, this is a micro cap, and they're already profitable. This is the most profitable quarter they've ever had. So anyway, I'm a big fan of Innodata. 5 of the Magnificent 7 are customers: Nvidia, Google. It's everything but Tesla and Apple. So Amazon, Google, Meta, Microsoft, Nvidia, they are all customers of this company. The federal government's a customer. Palantir's a customer. So I'm just a big fan of this one. But would I buy it now? No. 72 forward PE is definitely too high of a price to pay, but they have the growth. They have the Palantir type growth to justify the multiple. So you work for a financial institution or are you an analyst? I'm neither of those, Jeff. I'm a college student. Yeah, hey, none of this is financial advice. I'm definitely not an expert. Uh, so yeah, I'm just a YouTuber giving my just not financial advice. So James said Nebius stock, Nvidia partnership should help. Yeah, so Nvidia is trying to support that company. Nvidia owns a bunch of shares of stock. Nvidia, as you know, owns a bunch of Intel, CoreWeave, Synopsys, Nokia, and they actually own some Nebius stock because Nebius is a big customer. Basically, what Nebius does is they just own a bunch of graphics cards and they rent them out to cloud companies. So Nebius to report earnings following a $2 billion Nvidia investment. So yeah, Nvidia did buy a stake into this company, and that's part of the reason why the momentum's been so positive. But it's kind of like this circular theory that's happening right now. Like Nvidia is giving Nebius billions of dollars and taking a stake into them. And what is Nebius doing with all of that money? They're spending it solely on Nvidia chips. So anyway, let's see. So there's just crazy future revenue growth. Look at this. The revenue is going to get 590 million in 2 quarters. This is in US dollars. This is a Netherlands company, but we've converted the currency. The revenue is going to hit 590 million in 2 quarters. But the bad news is this is not a profitable endeavor. They're actually going to be losing money. They're going to 3x their losses. They're going to lose 250 mil next quarter and then lose 310 million the quarter after. That's the only thing that scares me. They have great revenue growth. It's like it's not just Nebius. It's CoreWeave, it's Iris Energy, it's APLD. They all have great revenue growth expectations, but they're all forecasted to over 3x their losses. They're all losing an insane amount of money because it's a super, super highly competitive industry, low margin industry, because all they do is rent out GPUs to people. And that's the part that scares me. And here's what Morningstar has to say. Dang, I didn't mean to be this bearish, but they're extra bearish. They say Nebius is overvalued. While the company is securing massive AI infrastructure contracts, significant caution is warranted due to a multi-billion-dollar cash flow burn, looming shareholder dilution to fund the capital expenditures, and a business model highly vulnerable to normalizing GPU rates. So yeah, that's the thing. Yeah, if we go to the FCF, which is free cash flow, yeah, they're spending more than they're making. They're losing over $1 billion of free cash flow, and they're losing a couple $100 million in net income a quarter. And they're not like when revenue doubles, like revenue is going to more than double. Actually, it's going to 6x. When revenue jumps like that, when revenue doubles, your losses should narrow as well. But in this case, the losses worsen whenever the revenue grows because it's not profitable. Anyway, I don't know about that one, unfortunately. All right, yeah, let's do don't you think it's too late to hop on this growth trend that's coming? So yeah, a lot of stocks, it is too late, but it won't be too late forever. But I'm just saying, like, look, if we go to the S&P 500, it hit an all-time high on Friday. Like for certain stocks, it is certainly not a good time to buy them. But for some, there's still some stocks out there that are recently good value. But I know what you mean. A lot of the good stocks that you actually want to own right now are too expensive to pay for. Like I'd love to own more Google, but look at Google in just 1 year. I didn't even time the dip. I'm not an expert. I didn't time the dip on Google. They're just up just in 1 year, Google's up 154%, and I'm up 143. I didn't even time the dip on them, and I'm just up 143, and unexpectedly for the mega cap Google. There's so many stocks like Google, Amazon that I wish I could buy more of, but they have run up so much recently. But I'm certainly not selling them. Like even though I'm up 140% on Google and Amazon, like here's Amazon, I'm up 38%. I'm not trimming or selling. I was loading the boat back here is when I bought a lot of Amazon shares. I bought 7 shares down back there. Anyway, let's keep going here. Look at a few more stocks, then I'll hop off here. I've been streaming for almost 4 hours, my longest stream in history. So I appreciate everyone that's here. I stream every Sunday the same time. Could you do Adidas, please? Yeah, actually, yeah. I remember what's funny is Kanye, they have a big Kanye West partnership. Kanye got in trouble, and then Adidas dropped Kanye. And then a couple months later, they're like, oh, yo, he was just kidding. We're taking it back. I forget the exact details of it, but it was funny. But they sell the Yeezys and stuff, which are big. So unfortunately, Adidas has not done too well, but it's not an Adidas problem. It's a whole industry problem. Like, look, Adidas is the same price as they were back in 2016. So a decade. They've been flat for a decade. They're at a 17 forward PE though. So that's actually a cheap valuation. Yeah, they're actually making consistent net income. I'm actually impressed about that. Yeah, that's real after-tax net income after they pay a couple hundred mil of taxes a quarter. So this company really does make like 500 million of net income a quarter, and they really do only trade at a 17 forward PE. You get a 1.3% dividend yield with Adidas too. I like Adidas. Um, or I don't know why I'm pulling up their website right here because we know what that is. But anyway, they're headquartered in Germany. Cool. So yeah, honestly, one of the reasons the stock is doing so bad is because look at Nike stock. Nike is also the same price as they were back in 2014. Nike has actually done worse than Adidas. Wow. Lululemon as well. Lululemon. I mean, these are some devastating charts. Same prices they were back in 2018. Under Armour's terrible. We won't look at them. Hey, see you, James. Take care, man. Hope you're having a great Sunday. Hope everyone's having a great Mother's Day. You be streaming through this week, boss? Yes, sir, Steven, we will. What time does your stream start? Usually around 12 p.m. Eastern time. So it's currently 3:30 for me right now. It's usually 3 hours before right now. Usually around 12 is when I start the stream. So, all right, we'll look at like last one here. Hims. This is like a healthcare delivery business. They have a lot of subscribers, but there is a lot of increased competition from Amazon. Basically, a lot of people pay for Hims subscription to get prescriptions like a weight loss prescription delivered to them. But Amazon now does the same thing. Amazon sells Wegovy pills, Ozempic injections. They sell everything. Basically anything you can get on Hims, you can get on Amazon. But actually, I don't know about that exactly because Hims has some like hormonal products. But anyway, they have like 2.4 million subscribers. Morningstar says they're overvalued. Significant regulatory and legal uncertainties surrounding compounding weight loss products and intensifying competition in the low barrier telehealth space require caution. Yeah, I really feel like the Ozempic, like weight loss prescriptions are going to be very commoditized and the margins are going to come down, which is good for us as a consumer. But yeah, look what that did to their margins. So Hims and Hers, the revenue grew 28%. So the revenue grew 28%, but the net income fell by 20. What does that mean in English? That means margins collapsed. Their net margin fell 40% year over year. And even on this dip that they're on, like they're down bad from this like $70 peak. They're at $28. They're not exactly cheap even now. They're at a 53 forward PE. So 53 times next year's net income. It's actually more expensive than Amazon. So that's the only thing that scares me is that like, it's a company that delivers you, well, a lot of their profits in the past came from specifically delivering weight loss prescriptions. Like they didn't make much margin selling the hormonal products and stuff. All of the bulk of the margin came from the weight loss stuff. And now they sell it at a much lower price and for a much lower margin. You said the good stocks are too expensive to buy. What are some of the things you look at others do? Yeah. Hey, MH, there's a lot of factors that go into it. What are you using to analyze these companies? Yeah, hey, Jay, if you'd like to get this app, this is a brokerage where you analyze stocks. It's actually the first link in the description. It's a brokerage called Moomoo. It's free. It's where you analyze stocks. Yeah, you can just type it into Google called Moomoo, or you can use my affiliate link in the description. But yeah, for me to buy a stock, it just has to have really good financials, like a company I can trust. Like I'm not buying some small cap. I'm not buying some crypto money losing startup. I want to buy a company with real, like an S&P 500, high quality, high barriers to entry company that prints net income, so much net income and free cash flow that they have leftover room to do dividends, share buybacks, and buy companies, do synergistic M&A, ones that constantly beat on earnings in an industry that I love. There's certain industries I love, like the electrical super cycle that's happening, like MEP companies, mechanical, electrical, plumbing companies doing the complex electrical work for data centers, HVAC, heating, ventilation, air conditioning, nuclear, utilities. There's a lot of sectors I love. And instead of just buying Nvidia, you can buy the whole ecosystem, buy the companies, like doing the HVAC work, the MEP work, the copper cables, the nuclear plants powering the data centers. There's so many like AI infrastructures, like ways you can get exposure to them. All right. I guess HPE versus HPQ. Wait, HPE is a Hewlett Packard, and this is HP. So HP, this is that like laptop company. They sell hardware, HP personal systems and printers. So this is that printer company. Yeah, we have an HP printer at our house. So yeah, we have an HP printer. Actually, they print money. The money hasn't grown, but they still really do make 500 to 700 million of after-tax net income a quarter. Actually, if we go to the annual profits here, it's kind of declining. Look at that. Like in 2010, they were making 8 billion a year of net income. Now the net income every year is 2 to 3 billion, way lower. So I can start to understand why this stock also, yeah, it totally starts to make sense. The market cap cannot escape this range because the profits aren't growing. So this stock is the same price that it was back in 2002. That's the tough part about that one. And they're very leveraged. So yeah, they make a couple hundred million net income a quarter, but it doesn't really grow and it might be slightly declining. But HPE, what's that one here? Hewlett Packard, that one is at an all-time high. We saw that other stock was the same price that it was in 2002. This stock is at an all-time high, and this company does cloud and art and AI. Cloud and networking company, which, oh, look, 40% of the company comes in the US, then Europe, and Africa. So anyway, two very different companies. Hopefully that was kind of helpful there. But anyway, that was the stream. I hope you guys have a great rest of your Sunday. Please hit the follow button. And if you haven't hit the like button already, please hit the like button. It would still help me out even if you haven't hit it, and even though we're ending the stream. And let me end this with a portfolio update. Let me share with you every stock that I own. Here is my Robinhood portfolio right here. This is my dividend only account where every stock in here pays a dividend, but most of these are like dividend growth companies. You know, see Google, Meta, Constellation Energy, United Rentals. So here's our total percent change on every stock. The only company we're down on is McDonald's. And here's our performance over the past year. We're up 18% the past year, which has underperformed. If we go to the S&P, the S&P is up. Can y'all believe that? Boring S&P 500 is up 30% from 1 year ago exactly. I've underperformed, but hey, I'm not going to complain about 18%. Also, we have a Roth IRA. And someone said, speaking of data earlier, that was what moved our account on Friday. It grew 7% on Friday. But yeah, we started this exactly a year ago pretty much. It hasn't done too well in the year that we've had it. We're down 2% all time. But yeah, data, they were up 85%. And here's our total percent change on every stock in here. I actually, if you want to see more of my portfolio where I talk about all the companies I own, check out my second most recent YouTube video. I did a 4-year stock portfolio update a couple of days ago. I hit 4 years ago investing in the market exactly. And then we have, this is our main winner, our Moomoo portfolio. At the top left, it's called our buy and never sell portfolio because we're not allowed to trim or sell a stock after we buy it. And that's the reason we've done so well. Like Powell Industries, we're up 1,000%. Most sane people, you know, when they're up 100 or 200% on a stock, they'll at least trim a little bit, but not me. I'm not allowed to in this account. So yeah, we're up 1,000% on them, 400% on Comfort Systems, the HVAC company. And so, yeah, that has led us to grow 73% just since January 1st. So just since January 1st, we're up 73% versus the S&P 500 up 8%. And if we go to the past year, we are up a crazy 181% from exactly a year ago. And yeah, the S&P 500 is up 30. So anyway, yeah, that's this portfolio right here. We got Amazon, Coca-Cola Consolidated, Amphenol, Moog is my most recent purchase. It's that aerospace and defense patent company. And then finally, we have I know I got way too many stocks for that's my biggest critique. I have too many holdings, like diversification, but I'm just a stock picker. Here's our Weeble account. This is just like my risk on account. I can do whatever I want. It's not like a dividend only or buy and never sell. I can just do whatever. We're only up 24% all time, so we definitely haven't outperformed the market. But yeah, here are all our top performers. AMD's been a monster. They just hit an all-time high. We're up 270% on them, 200% on Dave, 150% on Clear Secure. And actually, I made my buy and never sell portfolio because some of my biggest regrets are selling stocks. Like Robinhood, I only have 5 shares. I used to own 55 more, but I sold those 55 shares at $36 and it's $77 today. So I regret every share I've ever sold of Robinhood and a bunch of other companies. I used to own a bunch of Palantir and I sold all my Palantir and I would have been up over 1,000% if I didn't sell it. So that's why I'm a big fan of diamond handling. Same with SoFi. I only have 24 shares left. I regret every share I've ever sold of SoFi and Robinhood. So point being, once you're up on a stock, you can trim it, but don't fully sell out of it. Anyway, hit the like button if you enjoyed. We stream every Sunday this exact same time, and we're going to be live over this week. My college finals just ended a couple of days ago, so I know I'm a lot more free to be able to stream, and I'm trying to do this more. So yeah, thanks again for being here. Hit the like button if you haven't already. It's greatly help me out. And if you're on the YouTube stream, if you're on TikTok, please move over to YouTube. That's the best way to support me. TikTok keeps removing my For You page eligibility, so the TikTok stream is cooked. But so thank you to everyone on YouTube the most. Y'all the best. So see ya, everyone. Thanks again, Edward, MH, Silver, J, James, Norman. I'm sorry if I missed some stocks. I probably missed out on a bunch of stocks. Yeah, dang, my bad. Signal and Norman. I missed out on Hammond and Navitas. And thanks to all the new members. Yeah, we had like a new member. Yeah, if you want to join the Discord, I have a private Discord. I made it the least amount of money possible. It cost $1 to join. I only made it $1 because I don't want any bots or scammers to join. So yeah, if you want to join my private Discord, it's $1. Link in the description. Or if you become a YouTube member, you can cancel your membership right after. You get permanent access to the Discord as well. It's on a community post. See ya.